This is the awful truth. There's always someone in the family that's pushing it.
This lady does not deserve to be taken advantage of, especially at your age with your own grandchild.
Yeah.
My grandma is having to sue them. I'm testifying against them. Nobody's talking. They're one floor below right now. I get afraid to go on the elevator. It's sad that it had to devolve to this.
It's like a soap opera to me.
It's a very sad thing.
It's a family feud.
A family feud.
Here's a family that, on paper, you would think has the wealth that so many people seek, yet at the end of the day, it seemed to sort of rip everybody apart. My name's Tom Schoenberg. I'm a senior reporter here at Bloomberg News, cover financial enforcement. I was approached by someone close to the Schottenstein family and asked whether or not I would be interested in writing about Beverly Schottenstein and this case that she had against J.P. Morgan. And it was immediately clear that there was a great story here to be told. So I started just, assembling all sorts of documents that the family made available to me. That included a diary that Beverly had begun writing when she started having suspicions about what was actually going on with her money. Beverly obtained her wealth from the Schottenstein kind of retail empire that has at times included Big Lots, Value City, American Eagle Outfitters, DSW Shoes. Beverly's husband died, and at which point they sold off their portion of the company, bringing them an enormous amount of wealth at around 1990. Estimates of her wealth were around $90 million. She, for many years, had that pool of money being managed by outside advisors. Her grandsons in the late 2000s had both graduated and were becoming financial advisors. She gave them a little bit to work with, and over time, her grandson, Evan, became the trustee of her entire estate. Managing sort of family money is not a conflict. In fact, some ways in wealth management, it's kind of how you get your start. It's kind of the seed that you need to sort of get going in the business. But Beverly started having suspicions that something was wrong probably in around 2016.
Well, there were suspicious things, but taken separately without everyone talking about their own experiences, it was hard to really put it together.
She had written a check to her caretaker, Dawn, that bounced. So she went down to her local Chase branch to sort of find out what was going on. She wasn't getting paper statements in the mail, so she asked them to print out a number of her statements having to do with her checking account and her credit card account.
So we went to the bank and asked for the statements. And she got a whole year and going through all of them, page by page by page.
And it was there she saw all sorts of charges that she said she didn't authorize or didn't know about.
I was becoming very, very suspicious. I was starting to look in the money part, and that's what bothered me more when I saw that money was going. And I was not a big spender.
Around the same time, Dawn, she starts noticing Beverly's son, who lived in the condominium below her, came up with Evan with a shredder and started grabbing papers in her office area, including some with J.P. Morgan letterhead, and just started sitting at the kitchen table, just shredding documents over and over.
Yeah, they came in one morning.
They used to do it in the back.
Through the back door, and they brought the shredder inside. And then they went in the drawers in the office and took out all the papers, and they started doing it. I was very suspicious because I know you don't go around and destroying papers.
Beverly said that they had done this many times before.
That's when she said to me, Dawn, I'm going to write my feelings in this black book.
Diary.
And it's a diary, and she started writing. Each day she would write a little at a time.
Around the holidays of 2018, a package had arrived, a FedEx package, and in it were materials about a venture capital fund based out of the Cayman Islands. Dawn and some other family members take a look at this, and they see that Beverly is signed up for this fund to the tune of $5 million over the course of several years.
And that was really the beginning of it. That was sort of the tip of the iceberg when it became obvious that something was going on, that my grandmother really wasn't aware of this fund.
You know, Beverly started to panic. She got really upset and called, JP Morgan's headquarters in New York and asked for Jamie Dimon. She said she was told someone would call her back, but she says that never happened. She wrote a letter to Evan and Avi, and in there she laid out a number of things that were concerning her: unauthorized trading, the checking account. She had about $1 million worth of jewelry in a safe deposit box, and that her son Bobby had the key to that box, and that jewelry had gone missing. All this was kind of packaged in this, 5-page handwritten amendment to a will and trust.
There's such an evolving narrative about why the jewelry was taken. The only truth we really know is that the jewelry is gone. But why it happened, there have been a lot of different stories.
You just don't take your mother's wonderful things and hand it out.
And they emailed that note to J.P. Morgan to seize all activity on her account.
And it ended up setting off a firestorm after that. As soon as they got this email that there was a cease and desist and that she wanted to send her money and change brokerage firms, they were actually vacationing one floor below downstairs. They're there right now.
The next day, Beverly's in her place. The granddaughter's still in her place visiting. Dawn is there, and up comes Bobby kind of barging through the door. And he's screaming about what was sent to the JP Morgan. They're now investigating now. And he's furious, takes his mother and sort of puts her into a chair, gets pen and paper, and she says physically forced her to write a retraction letter.
They were pushing me around.
It was a scary time. I was really afraid too.
I had to take her to the doctor, and she did an x-ray because she was in so much pain.
The locks had to be changed. The phone number had to be changed. I really thought we were going to have to hire guards to be outside just for protection.
Oh, it was terrible.
Horrible scene.
Beverly brought her case before the Financial Industry Regulatory Authorities, usually known as FINRA. It took several months of hearings. She sees all sorts of transactions that's going on, hundreds of them that she claims that she never knew about, never authorized, but yet were logged in JP Morgan's files as having been direct requests from her. That included the sale of a large amount of Apple stock worth several $1 million, as well as all her stock in Big Lots. Over the course of their time with JP Morgan, Evan and Avi were making all sorts of trading on her account that was generating millions of dollars in commissions for themselves and the bank, yet she was not sort of getting any of the type of gains that you would expect sort of an $80 million account in a bullish market to be able to get. They issued a ruling entirely in her favor, finding that her grandsons, as well as JP Morgan, they were liable for violating their fiduciary duty, misrepresenting themselves, and they also found that the bank and her grandson, Evan, were liable for elder abuse. Evan and Avi, they were fired from JP Morgan. They issued an award of about $19 million. I reached out for comment, and JP Morgan emphasized that Evan and Avi were no longer with the firm and that their actions do not represent the sort of values of the bank. I reached out to Evan and Avi, heard back from their lawyer saying that, they disagree with the law and the facts that FINRA kind of used to decide the case against them and are seeing if they can have it withdrawn. Her son, Bobby, wrote her a letter, said his sons weren't criminals, and he also admits to taking her jewelry. And he says he needed it to pay off some bad business debts he had.
They never once came up to say, I'm sorry.
If there had been an apology and some acceptance, and asking for forgiveness. From my grandmother, I don't think we'd be in the position that we are now.
Since the piece came out, we've received dozens of messages from people, many of whom are telling their own sort of personal tales of, kind of financial advisors gone bad, or family members who got control of an estate and abused, those within. It seems that it's really resonated with a lot of people. I keep, hearing a lot of feedback about Beverly and how, a lot of people feel she did the right thing.
You're never too old to stand up for yourself and try to right an injustice. She was adamant that she wanted to stand up for herself, but at the end of the day, they did wrong.
It's a painful life lesson. Beverly taught them that you don't mess with grandma.
On April 20th, oil markets did something they never had before, and they crashed, went into negative territory and closed the day at minus $40. Meanwhile, in a place called Thaden Boyce in Essex, a group of 9 traders, led by a guy called Cuddles, made $660 million over the course of a couple of hours.
The price of oil has collapsed to a record low.
We've never really seen anything like it. WTI this morning down more than 35%.
People maybe wouldn't have been so surprised if the oil price had fallen to zero, but the oil price went to minus 38. It went far lower than anyone had expected. And so lots of people in the market were saying, well, hang on, something else is going on here.
A couple of months later, I started to get wind through a kind of network of sources that a tiny firm in the outskirts of London had made a huge amount of money that day and potentially had some part to play in what happened.
The information we got was that 9 traders at Vega Capital London had made in the region of $660 million in one day. As a group, I think they made as much money in one day as Apple makes from its international sales in one day. I mean, it's an insane sum of money.
Did they pull off a fantastic trade? Did they predict the way the market was moving and get it absolutely right? Or was there something else going on, and had they actually done something that breached market rules in a bid to sort of push the market? And that investigation is ongoing. So Paul Commins is a trader who cut his teeth in the pits in the 80s and 90s when everyone had a nickname. His was Cuddles. If you can imagine, that was a very sort of cutthroat type of world where people are doing, hundreds of thousands and millions of dollars trades by shouting at each other, giving hand signals, and then sort of scrawling on scraps of paper.
The culture of the trading pits in London was very influenced by the working class guys who became traders there. They weren't like the city bankers that had gone before them. They weren't usually Oxford or Cambridge. They didn't wear Savile Row suits. They were ordinary working guys who happened to have a talent for trading. And a lot of them came from Essex.
I think it was 400 traders in the pits, and Cuddles in his oil and gas pit was described to us as amongst the top 3. In amongst that, was very successful and made very large amounts of money as a young man. But inevitably, mechanization and the arrival of electronic markets was the kind of death knell for the pits. And in 2005, the IPE closed down.
And when the pits shut down, a lot of the traders who worked there lost their jobs or quit or went to work for financial institutions. But Paul Commins decided to start his own trading collective out in Essex.
Some of them are ex-pit guys, cut from the same cloth as him. Lots of them are actually sort of in their 20s, and they're his, drinking buddy's son, or they're his own kids' friends from football. They're young lads, hungry and ambitious, and he brings them into the fold. And fairly shortly, he's got, maybe a dozen or so traders that they're independent, let's be clear, but they're all part of this collective.
Yeah, I'll let Liam deal with Essex.
I am from Essex, so I feel like I'm free to, to get into this.
Sweet, as they say.
If you were to ask someone in Britain how they would imagine a kind of Essex person, they would see someone who's maybe slightly flamboyant, with a sort of Cockney accent, a sort of Guy Ritchie-style accent. Not afraid to splash the cash, but it's probably pretty bright and has done well for themselves.
Don't even make sense, does it?
But, these guys, they drove around very nice Rolls Royces and Bentleys. They went to places like Marbella on holiday.
Thaden Boyce is a very wealthy place. You have to have considerable income to be able to afford to live in that village. It's a really nice place to live, and it's 20 minutes tube ride away from the city.
Earlier in the summer, we have this lead, which is that there's this tiny firm called Vega Capital London, and they were the biggest winners from the biggest oil crash in history. Anyone that covers markets is going to be surprised about that. You're thinking your BPs of the world or your Glencores, but it's this tiny firm.
And one of the big challenges that we had was actually finding out who worked with Vega Capital. It wasn't immediately obvious, and at first we had absolutely no idea. If you go to the Vega Capital website, it says it's under construction. If you do basic online searching, it's very difficult to find anyone who's publicly connected to the company.
So inevitably, we're incredibly curious at this point. Like, who the hell are these people?
The more reporting we did, the more it became clear that this group were connected socially as well as professionally. They went to weddings together, they played golf together, they would go on holiday together. We found out that a number of them were members of the West Ham Supporters Club in London. A few of them started companies together, so you could see all the connections between them and start to see a distinct group emerging.
And it really just was this kind of shock that, this wasn't just like a hedge fund or a firm you'd never heard of. This was actually a group of buddies who all had the same experience on this day and had all made a huge amount of money. So if you're an oil trader, there's a number of different ways you can trade, and probably the most popular is WTI futures contracts.
And it's basically a contract that says, I'm going to buy 1,000 barrels of oil from you at this point in the future, or I'm going to sell 1,000 barrels of oil to you at this point in the future.
It's actually just a financial contract to gamble on to predict whether oil is going to go up or down.
On the 20th of April in Essex, there had been signals for a while that this was going to be an exceptional day in oil markets. And we know that some of them arose early and started their trading in the early hours of the morning while it was still dark outside.
Essentially what they were doing is buying contracts that gave them an obligation to buy oil at whatever the price ended up at 2:30 p.m. So they're basically placing a bet that oil was going to fall throughout the day.
But they're simultaneously selling lots of oil as well. And whether they make a profit and how much profit they make is the difference between what they buy the oil for and what they sell the oil for. Now, of course, we now know throughout April 20th, the price dropped and dropped.
So this is going very well for them. They are committed to selling oil at these prices, and the prices are continuing to fall, which means they're going to be able to offset it and buy oil at cheaper at the end of the day. Now, once it gets to kind of 1:30, 2 p.m., that's when things start to get really interesting. Suddenly there's a kind of influx of buyers and sellers, as desperation increases in the market and trading volumes go up. Now at 2:08 p.m. exactly, something bizarre and unprecedented happened, which is that oil passes into negative territory.
And it fell to a record level of minus $38.
We've never seen anything like it, period, in terms of the contraction of the global economy.
That huge gulf between what they were buying the oil for and what they were selling it for enabled them to make more money than they ever thought possible.
So their profit was the difference between minus 37, and all of these positive numbers on every contract they sold.
The price of crude briefly hit minus $37 a barrel. For one group of traders operating from a small office, it was a very, very profitable day.
It's important to remember this had never happened before in the history of oil trading. No one could have predicted it.
I can't think of another example of where you enter a trade and you get paid on both sides. You get paid both to sell and to buy. It's unthinkable.
One thing we know about the Cuddles Trading Arcade is that they were very comfortable taking large risks. And, you have to be clear, this was a large risk.
Yeah, we spoke to oil traders, both people that know these guys and people that don't, and they all say that this is, incredibly risky.
And that's actually what stops a lot of oil traders doing trading like this. They simply aren't willing to stomach the risk. But Cuddles and his friends were.
So when the kind of final calculations came down, the group of the 9 most profitable traders made $660 million or thereabouts between them. I mean, if you can imagine, I think 3 or 4 of them made in excess of 100 million each.
One of the astonishing things about this trade is that 2 of the individuals who made more than $100 million in a single day were in their 20s. One of them was 22 years old. Only a few years earlier, he'd been posting on his social media about doing teenage stuff with his mates in town and going to see girls and rap music. And here he is a few years later making $100 million in a single day's trading. When me and Liam discovered that, we couldn't believe it. We couldn't believe what we were seeing. Oil trading is a zero-sum game. Anytime you're making money as an oil trader, someone else is losing it.
Amongst the biggest losers were the investors in this Chinese fund, Crude Oil Treasure Fund. There were thousands of them, and they lost everything.
Lots of people had put their savings into oil funds. They lost money that day. Big banks and brokers who sort of stand in the middle of trading parties, they lost money that day.
And another interesting thing is that oil-producing countries like Kuwait or Canada, they sell oil as an average of the WTI closing price over the preceding month. So the fact that one of those numbers in that average was minus 37 meant, if you can imagine, countries like Saudi Arabia and Kuwait potentially lost a couple of dollars on every single barrel of oil they sold that month.
Vega Capital's traders made such an extraordinary sum of money that it was inevitable there would be some scrutiny of what they did. But it wasn't just the sums of money they made. In the vital half an hour before the settlement price was set, they were by far the biggest sellers of oil futures in the market, which is an incredible thing to think about when you consider that the other participants in that oil market are going to be the world's biggest banks, oil majors, BP and Shell, and here you have a group of 9 guys in Essex who are having this significant influence over a global market for oil.
I mean, I think you have to assume that if these guys had made $7 million or $10 million, they probably would be celebrating in Essex right now. But the fact that they made closer to $700 million has meant that they are facing understandable scrutiny.
We wrote individually to all the Vega traders who did exceptionally well that day, and we got a letter in response from a law firm representing the group. The law firm was at pains to point out, number one, that they haven't been accused of any wrongdoing, that they all traded independently and separately, and they'd basically all made up their own minds that this was what was going to happen in oil markets based on publicly available knowledge, and decided to execute this trade.
What I love about these stories is there's a real variance of opinion, and some people will look at what happened and think that must be dodgy. They all traded at the end of the day. They all made a huge amount of money while all these people lost. That's shocking. But lots of people say these guys are at acute disadvantage. They're in a market that's inhabited by, huge technology-driven funds and firms and oil giants that have got all the advantages in the world, and when you get a bunch of Essex geezers who essentially beat the market and find a way to make a huge amount of money, they should get a pat on the back, really, because that's the dream. Since this happened, a lot of the guys have stopped trading the monthly settlements that they'd done so well at in the past. Several of them have set up new companies. They've essentially gone very quiet. Any kind of social media presence they had has kind of closed down. By all accounts, they're, waiting this out.
It's certainly too early to try and predict how the regulatory investigations are going to pan out. We just don't know. There's a number of potential outcomes for these guys. Potential punishments if there are any findings of manipulation against Vega or anyone affiliated with it might be you could be fined, you could be banned from trading, and in the most extreme cases there have even been criminal prosecutions in the past of people who have been found to have been manipulating the settlement and misconduct related to trade at settlement. There are other outcomes too. One obvious one is going to be that they're able to walk away from this life-changing trade with all the money that they made and celebrated as heroes in the trading community. That they'll go down as legends.
It's very important, given the nature of the climate crisis right now, for the general public to have an understanding of what progress is or is not actually happening. And I think many readers right now, they'll see these hundreds and hundreds of companies making these big, bold climate claims. And they would be forgiven to think that we're well on our way to meeting the emission reduction trajectory we need to be on. And the reality of the matter is we're just not on that trajectory. And a key reason for this sort of disconnect is the use of offsets that aren't doing what they claim to be doing.
We have a massive potential for sort of willful blindness. We can convince ourselves of things regardless of what the facts are. And so that's what tends to happen in these cases. It's not that anybody is setting out to commit climate fraud. They sort of walk themselves into a situation and they convince themselves of one thing, and that allows them to convince themselves of another thing. But at the end of the day, they're doing something that makes no sense at all.
My name is Ben Elgin. I wrote the story about how the billion-dollar market for carbon offsets is setting back the fight against climate change. So one of the challenges in reporting on carbon offsets and trying to figure out what's going on is really finding good experts who have been steeped in this marketplace and are willing to candidly talk about it. One of the best people for this is a fellow named Mark Trexler, and I've been talking to him for more than a decade.
My name is Mark Trexler. I've worked in climate change for the last 30 years. I was actually hired by the World Resources Institute in Washington to work on the first carbon offset project in 1988. In terms of defining a carbon offset, one of the beauties, so to speak, of greenhouse gases, sort of the silver lining of greenhouse gases, when you put up a molecule of CO2 into the atmosphere, it can be anywhere in the planet in 7 days. And therefore, if there's an option to reduce emissions on the other side of the planet, and you can do that very cheaply as compared to doing it in your factory, for example, then why not pay that person, that factory on the other side of the planet to reduce their emissions? Then you are, in a sense, offsetting your emissions, and the atmosphere doesn't really see your emissions anymore.
So carbon offsets have been around for quite some time, and they were actually key with these international climate agreements, such as the Kyoto Protocol, which mandated the wealthiest countries reduce their greenhouse gas emissions.
The treaty was signed on the 11th of December, 1997.
Decided. The business community in general saw carbon offsets as a huge opportunity to comply with whatever policies and measures might be coming down the pike on climate change much more cost effectively.
We've seen a huge surge in companies making big proclamations about how they're going carbon neutral or zeroing out all of their carbon emissions.
We're going to reduce our carbon footprint to net zero.
Unilever is committing to net zero emissions.
We can achieve a net zero emissions world.
We began looking at these corporate claims of dramatically reduced emissions, and we noticed so many of these companies were using carbon offsets to achieve these aims. And as we began to look at the carbon offset projects themselves, what we found is that the environmental benefits claimed by these companies are not actually what they seem to be. And as we sort of saw and spotted a number of these very aggressive carbon offset projects, which appeared to be generating inflated credits or bogus credits, we saw a number of them were associated with the Nature Conservancy. This surprised us. The Nature Conservancy is the world's biggest environmental group. They have about $1 billion a year in revenues, and they've been around for 7 decades. They've preserved about 125 million acres of land, and they've done so many good works over the years, and they've been very strong in terms of working with corporate partners. The Nature Conservancy has taken a different approach, a very pragmatic and pro-business approach. They will not go out and criticize a big polluter, but they're very happy to work with them. Some might say that, well, that's selling out, but others would say, and those at the Nature Conservancy would say, these companies have deep pockets. They can help fund important preservation work, and we have absolutely no problem working with them on this stuff. So companies are very warm, and they've partnered with the Nature Conservancy for many years. And yeah, it definitely lends a sheen of credibility to these projects.
Here's 20 new reasons to visit Disney World this year. 1, 2,
if you look at, for instance, Disney, that's a sprawling company with theme parks and cruise lines that burn up diesel fuel. They have office buildings and television studios that consume electricity. So these companies are trying to make major reductions in their carbon footprints, but it's very difficult to change these fundamental ways their businesses operate. So Disney has been a big buyer of carbon offsets that are orchestrated by the Nature Conservancy. One of the projects that they buy from is called Pennsylvania Ridges. And that's a plot of land. Most of the land is actually about a 3-hour drive outside of Philadelphia. Interestingly, this land, 3,000 of these acres, was actually acquired by the Nature Conservancy in the late 1990s. This land was imminently threatened. There was a pending logging contract on this land. So they do what they've done so well for all of these years, which is they go out, they raise money from local philanthropists, and they go buy this land to protect it from developers and loggers. And at the time, according to an archived version of the Nature Conservancy's website, when they were proudly announcing this deal, they said, these threats have been abated because of this acquisition by the Nature Conservancy. So it's really interesting now, fast forward 2 decades to earlier this year when they put forward this carbon project. And if you look through it, this land is a key part of that carbon project. And what they're now saying is this land is now once again imminently threatened. 72% of the trees are going to be cut within 5 years. Now, this is just astounding because this land is owned by the Nature Conservancy. They do not clear-cut land that they've bought through philanthropic donations. So this scenario that they've put forward to get carbon revenues is not really plausible. And what that means is when you have Disney coming in and buying these credits, when it eventually lowers its carbon footprint because of these credits, well, that won't be a credible or truthful claim by Disney. So this is an organization that truly understands the threat of the issue of climate change and is wanting to do its part to address this. However, in this situation, it just appears their drive, which they've had for decades, to increase the amount of revenues that it can use for land preservation work, Nature Conservancy and many others see that the carbon credits as a pot of money that they can tap into to further their own benevolent aims. But unfortunately, what this has resulted in is claims of climate progress that just aren't really happening. So the Nature Conservancy defends vigorously these deals, and they and others will say, look, our projects are just following the rules that these registries set up. So some would also put some of the blame on the registries themselves because they're setting up the rules which allow these vapid projects to get up and sold. So we've reached out to all of the companies we mentioned in the story, including Disney. They didn't want to be interviewed for this story, but they all told us that, look, we have to rely on the experts out there, and those experts, they say, are these carbon registries that have been set up. Most of these Nature Conservancy deals are set up and sold on this exchange. It's called the American Carbon Registry. Now, it's the oldest of these registries that allow voluntary carbon credits to be sold. They've been around since 1996. What these offset registries do is they set up rules, and any carbon offset project has to follow those rules. But there's this tension that's always there. If the rules are too strict, then it's going to be very hard for carbon offset projects to get up and running. So there's this balance going on where the registries want rules that attract projects, but they don't want it to be so strict where it will disincentivize projects from getting listed.
One of the challenges with designing carbon offset systems is that there are normally two people at the table. You have buyers and you have sellers. And to some extent, you have policymakers, but you know, the buyers and the sellers are really the ones with the expertise, with the incentive to really participate hard, make a lot of things happen. And the challenge there is that both of them sort of want the same thing, or they're both happy with the same thing. They're happy with low-cost offsets and a lot of them, because that works for their business model. You end up, though, with nobody really representing the atmosphere, so to speak. Nobody's really representing the climate in those discussions. And so the policies end up biasing the whole system, and you end up in sort of a race to the bottom, and that's what we've seen happen. You know, when it comes specifically to the topic of carbon offsets, you know, I am a fan of carbon offsets in the sense that they can help mitigate climate change. They absolutely can. But, you know, if we're not going to do it correctly in a way that actually does help mitigate climate change, then it's nothing but a distraction. And, you know, after 30 years, you have to start wondering, is it really just a distraction? And that's really unfortunate, but that's where we are. Ultimately, what needs to happen is systemic change. You know, we're sort of nibbling around the edges with some of these different things. We need to change how we produce energy. We need to change how we transport ourselves. We need to change what and how we eat. You know, we need systemic change associated with transitioning to a low carbon economy. A lot of what we're doing today is not promoting systemic change. It's sort of trying to stick your thumb in the dike to preserve the current system. And at the end of the day, that can't really work.
the Hyperloop. There's a good chance you've heard the name by now.
This is the Hyperloop system. It can take people hundreds of miles in minutes.
The Hyperloop, a series of tubes that would transport people in pods at ultra-high speeds over long distances.
It's a remarkable new form of transportation that can whisk people from city to city in a flash.
29 minutes from New York to D.C., 30 minutes from L.A. to San Francisco.
For years, we've been seeing these futuristic, utopian renderings of some cross between a spaceship and a monorail. But lately, the Hyperloop is becoming much more real.
Yes! It was surreal to be even sitting inside a Hyperloop, and just even more incredible to actually be like riding down a track in something that was nothing more than a crazy idea 6 years before.
Companies all around the world have been developing and testing the technology needed to propel passengers at speeds of over 1,000 kilometers per hour. But for many, speed is only the first step to unlocking the full transformational effects of a new mode of transportation.
Fast is what we just sort of take for granted in the Hyperloop world. It's the network effects that really deliver the benefit. And that opens up a completely different scale of economic opportunity.
We've got planes, trains, automobiles, and boats for getting around Earth. But what if there was a fifth mode? And I have a name for it, which is called the Hyperloop.
The Hyperloop?
Hyperloop, yeah.
In 2013, while riding high on the growing success of Tesla and SpaceX, entrepreneur Elon Musk released a white paper outlining the basic framework of the technology he called Hyperloop. The basic idea goes a little something like this. A tube reduces the air pressure to a near vacuum-like environment. A Hyperloop pod is then suspended in the tube, usually by magnetic levitation. The whole pod can then be propelled forward. Because there's no traditional friction sources like air resistance or rolling friction that would push back against the pod, the Hyperloop is able to move at incredibly high speeds and do so fairly efficiently. Despite its futuristic name, however, the general concept behind Hyperloop is actually pretty old. In fact, New York City's first attempt at an underground public transit system in the 1870s was based on a similar principle. The pneumatic transit system was short-lived, however, only stretching one block and topping out at a rather leisurely 10 miles per hour. While Elon would make some 21st century improvements to this concept and bestow a very 21st century name, he wouldn't end up pursuing the technology itself, instead electing to focus his efforts on something a little bit deeper, literally digging the requisite tunnels via his boring company. It would take another billionaire industrialist who dabbles in spaceflight. No, wait, not that one. Yeah, that's the one. After Richard Branson would make a large investment in the company Hyperloop One, it would be renamed to Virgin Hyperloop.
What we've always been trying to do as a company is show that this technology could work, that it could be made safe, and that ultimately it's something that's happening in the next couple of years, not the next 20 years.
Josh Geigel is the co-founder and CEO of Virgin Hyperloop. In a familiar tech startup story, he's seen the project go from a garage to a large-scale testing facility outside of Las Vegas.
So we started building the first kind of Hyperloop system in 2016. We've done a lot of work, about 500 tests that we've done on that over the last 5 years. And what we realized that we need to do is take that technology, show that it can be commercial, so drive the cost down, improve the efficiency, improve the performance. But the key thing is actually making it approachable and safe for individuals.
In order to do that, Josh, along with Virgin's head of passenger experience, Sarah Lucian, bravely volunteered to take the inaugural ride.
What her and I were realizing is we're the first two people sitting in a Hyperloop. The only type of people that have gone through this environment are in spacesuits, and there we are in just normal clothes because of the system, the safety of what we've designed.
3, 2, 1, launch.
And then once we started going, you felt a bit of acceleration. We accelerated a little bit harder than we would in commercial. It'd be like a sports car. Yes! We got to about 108 miles an hour on that test. And it's a short run. It's about 500 yards or so. And came to a stop.
The test, lasting only about 20 seconds and covering only a quarter of a mile at just over 100 miles per hour, is a long way away from a true functioning Hyperloop. But as for optics, it's a crucial step for the future of funding.
The number one question we got from investors or from project proponents or just people in general was like, is a Hyperloop safe? And what better way to show something is safe than by actually getting people on it?
But convincing investors and governments that would likely be fronting some of the construction costs for an unproven technology is no easy task. First and foremost is the question of safety.
Most people don't know how an airplane works, but yet they get on an airplane. They get on an airplane because, it's faster than driving, and most importantly, they've probably gotten off of one before, they've seen someone get off of one before. And so what we set out to do was actually show that Hyperloop could be safe with two normal people, not astronauts, not adrenaline junkies or test pilots or anything like that. Two normal people getting on a Hyperloop, and then most importantly, those two people getting off.
But beyond safety concerns, constructing Hyperloops will undoubtedly require a significant capital investment to the estimated tune of around $60 million per kilometer of track. So a track from San Francisco to Los Angeles, for example, is likely to come with a price tag over $10 billion. And before large governments are willing to come in and front those costs, investors who are funding Hyperloop development must accept it as a long-term mixture of technology and infrastructure investing.
Investors that are used to short returns because you're developing apps or something to that effect, those aren't the investors that really get excited about Hyperloop. What you start to see is the people that are looking at platform technologies, right? So this idea that because the smartphone existed, Uber could exist, right? So who are like the Vanderbilts of this century? And that's the part where you're going to get a lot more no's than yeses. But those people that have the ability, the fortitude to stick it out, to see the game-changing platform here, those are the people that we're looking for. And since we've done that passenger test, there has been a lot of interest that's really, this is a lot sooner than I thought.
Envisioning the ripple effects of what Hyperloop could achieve, though, is fairly challenging at this stage of development. It's fast, yes, but for point-to-point travel, traditional maglev trains can move pretty fast as well. And outside of China, South Korea, and Japan, even those haven't seen much adoption elsewhere due to the high costs and questionable profitability. The Shanghai line in China, for example, loses around $100 million every year. Hyperloop companies, however, believe they can offer something different than traditional railway lines.
My name's Alan James, and as far as I know, I'm the only guy on the planet who's written a government-level business case for 300 kmh conventional high-speed rail, 500 kmh maglev, and 1,000 kmh Hyperloop. It's fundamentally about moving people from where they are to where they want to go, when they want to make those journeys, and doing it in much smaller numbers. So pod designs for Hyperloop range from 12 to 28 seats, typically. Why are they small? It's because small enables the network to operate flexibly. And a great example of that is the east-west strategic route across the north of England, from Liverpool to Manchester to Leeds. So to get from Liverpool via Manchester to Leeds by train is just short of 2 hours today. It'll probably take you 2 hours driving as well in average traffic conditions. Net result is those three city regions remain three separate entities: Liverpool, Manchester, Leeds. There's very little commuting traffic between those urban areas. Hyperloop absolutely changes that from the ground up. Liverpool to Manchester is a 5 or 6 minute journey. Manchester to Leeds is also a 5 or 6 minute journey. What that effectively does is create a single supercity economy.
In this vision, the Hyperloop acts a little more like a highway, where pods have fixed destinations and don't need to stop along the way. Meaning you can travel on a Hyperloop network from, say, Liverpool to Leeds, while the pod behind you travels from Liverpool to Manchester. And if that metro Hyperloop network is connected to other networks from the same location, you could travel from Liverpool to Paris or Liverpool to Amsterdam, all without making a single stop.
For passengers, for business, for leisure, that is utterly transformational. For high-value freight and logistics, it's equally transformational. But critically, if you do a Hyperloop network at scale, you begin to deliver massively significant carbon savings too.
A multi-regional Hyperloop network could become a replacement for both short-haul passenger and cargo flights and traditional ground transportation, both of which are significant carbon producers.
One Hyperloop-connected distribution hub, perhaps at an airport that is predominantly used for international air freight, replacing maybe 10, 12, 15 distributed road hubs. It takes a lot of polluting and inefficient truck haulage off the roads. That itself means roads gain extra capacity.
Hyperloops will still need to use electricity to both move pods and maintain the near-vacuum environment in the tube. Proponents of the technology believe that this can be done by using renewable sources, including a combination of solar panels and battery technology that could be used along the Hyperloop itself. But even with all multipliers of time and carbon emission savings that a Hyperloop network may provide, the investment capital required to actually build such a network becomes even more economically and politically daunting.
Committing doesn't mean spending billions on day one. Committing means, how do we phase it?
One company in the Netherlands is working to develop that technology, and perhaps more importantly, the international coalition needed to make the Hyperloop network a reality.
So we are here in Europe's first full-scale Hyperloop test facility, where we can already prove every conceptual technology of the Hyperloop.
This is Tim Houter, a co-founder and CEO of Hart Hyperloop, headquartered in the city of Delft. And while this testing tube might not seem as large as others, inside is a key technology to create the on- and off-ramp type infrastructure of a Hyperloop network. That is, a lane switch.
That's something we can already test here. You can actually see it here, that the track is diverging from one track into two. That makes it possible to eventually split up the Hyperloop track in two sections. And in that sense, you can create a complete Hyperloop network that in the end will make it possible to travel, for example, over a whole continent. Take Europe, for example, with the same ease as you can now travel with a metro in a city.
The nice thing about this magnetic levitation system that we've developed is that there's absolutely zero moving components in the track. So for example, if you have to do a lane switch, all you do is that the tube basically splits up, and statically the tracks also split up. And whenever the vehicle enters a switch, it either pulls itself to the right with its magnets, or it pulls itself to the left with its magnets.
Lane switching on traditional rail requires the physical movement of the rail. Even modern magnetic levitation tracks use lane switching techniques in order to transfer trains from one track to another.
And this is a very crucial element, because this is the thing that limits the capacity and, in the end, the usefulness of the rail network. Because the moment that a track is switching, that means that at that moment you are creating an unsafe environment for the trains behind it. So you need a lot of space between trains. In a Hyperloop, because you have no moving components in the track, all the vehicles can be much closer to each other. You can achieve a very high frequency and basically have your vehicles moving and merging in and out of the network very much like a highway.
For now, though, Hart's physical testing has been limited by the size of their tube. Because the test track is only 30 meters long, they haven't tested this lane switch at speeds greater than 20 kilometers per hour. However, the company is working to build a new test site where it plans to increase that testing speed to 300 kilometers per hour.
We're now in a phase where we have proven most of the most important technologies in the test facilities that we already have. And we have also demonstrated the viability and the feasibility of a network. If you look at all the subsystems that it consists of, most of those are proven systems, already demonstrated in lab conditions. So we don't really believe that the technology itself is going to be the biggest challenge.
Because for all Hyperloop companies out there, actually building a Hyperloop system requires more than just a good product.
We're talking about the safety aspects, we're talking about integration into the environment, we're talking about the social aspects. Do people feel comfortable traveling in such a system? So it's about all these different aspects, and the complexity is really getting all the different stakeholders that are relevant and that do need to contribute to bring this to market, to get them all following the same roadmap.
In order to help build this coalition of private and public interest in Hyperloop development, HART in 2018 partnered with other Hyperloop companies from Europe and Canada. The goal was to define, establish, and standardize the framework to regulate Hyperloop systems.
Right now we are working with all the Hyperloop developers together in setting up the first, let's say, structure for starting the standards drafting.
One of the most important goals for HART is interoperability, which is essentially making sure the different systems can communicate with each other.
Interoperability is so important because what we want to achieve is actually have this seamless travel experience. So you don't want to end up, for example, going from Madrid to Paris and then switching because you need to use a different technology to get, for example, to Amsterdam.
The idea being that as companies around Europe create the first commercial Hyperloop tracks between individual cities, one day those can all be connected to a larger network.
Everyone that believes that Hyperloop is a future transport system also realizes that there is a need to have this network because that's where Hyperloop thrives.
Hyperloop is such a huge project. It's definitely not something that you can do on your own or as a single company. So you need to do it with a lot of other companies. You need to have the governments. And I think in that sense, the biggest challenge that we've encountered is to really get all the required parties together to take the steps in development and in commercial implementation.
HART's next plan is to build the European Hyperloop Center, an open testing facility which will include a 2.6-kilometer test track. And the company hopes to test travel speeds there at up to 700 kilometers per hour. Virgin Hyperloop is also racing to construct the first commercial Hyperloop route, with projects in various states of development in India, Saudi Arabia, and the United States. Recently, the company announced plans to build a Hyperloop certification center in West Virginia, which will include a 6-mile-long test track. Proving the technology here will be crucial if Hyperloop networks can find a home among infrastructure investments that the Biden administration hopes to make.
The idea that there's multiple Hyperloop companies, I think, is a redeeming aspect in the business. People really want to see something happen, so having multiple people move forward is good for that.
I was struck when Josh and Sarah rode the pod. 2 or 3 of the major outlets used the phrase, "We now have a new mode of transport." And although all of that technology had existed before those 2 human beings rode it, it was the moment at which those 2 human beings traveled that short distance down the tube that in popular imagination, Hyperloop became a mode of transport.
The metaphor I use with my team is that, the Wright brothers were first, but none of us fly on Wright brothers airlines anymore. If you don't continue to innovate, you're not going to be around, and so we'll continue to be at the forefront of building Hyperloop.
Back in 2013, Elon had an idea. I think the difference now in 2021 is some brilliant engineers have spent real time grinding out the details. And I thoroughly expect the next 3 to 5 years to be decisive.
This week, how hydrogen can transform our energy usage. We'll look at why the universe's most abundant element could be a game changer in the climate revolution.
Hydrogen technologies are not new. They are used in other sectors. We use them in space, on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes.
From iron ore to green hydrogen, one of Australia's richest men tells us about his pivot to sustainable energy.
Let's take action. It's practical, it's implementable. Let's do it now.
Plus, the hydrogen revolution. We'll speak with the CEO of Italian utilities firm Snam about his new book and how green hydrogen could be competitive within 5 years.
Costs are coming down and people are waking up to the fact that it's the only way to decarbonize certain sectors.
From Bloomberg's global headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. It's a new year, so here at Bloomberg Green, we're highlighting new solutions in the fight against climate change. And one of those is as old as the universe itself, hydrogen. It's the simplest element around, but could well be a game changer when it comes to turning around our dependence on fossil fuels. Today, hydrogen is used in the chemicals industry to produce petroleum products. It's also starting to be used in steel production, an industry under a lot of pressure to decarbonize. But it has far more uses as well, from powering cars to heating our homes. And Bloomberg New Energy Finance sees a seismic shift in the sector in the next 10 years as green hydrogen squeezes out dirtier alternatives. So-called gray hydrogen dominates today. But as renewable electricity gets cheaper and more accessible, so will green hydrogen. In this week's edition of Bloomberg Green, we'll explore what this push into hydrogen means for tackling climate change. We'll hear from Australian billionaire Twiggy Forrest about his pivot from iron ore to hydrogen, and we'll also speak with the CEO of Italian utility company Snam about his book, The Hydrogen Revolution. But first, what are we using hydrogen for? And why does it actually matter? Christine Lee Edwards explains.
Hydrogen, the most plentiful element in the universe. On Earth, we find it mostly bonded to oxygen in the form of water, or in other gases known as hydrocarbons. Hydrogen gas, H2, burns hot and clean, making it an attractive tool in the race to net zero. But isolating hydrogen from other elements is no easy task. Today, the cheapest way to do this is via chemical processes that break up natural gas. This releases a lot of carbon dioxide. Another method is to use electricity to split water molecules in a process called electrolysis. Although there is no carbon byproduct, a lot of electricity is needed. And if this power comes from burning coal or gas, it negates the zero emissions goals of using hydrogen to begin with. Hydrogen produced in this way, powered by fossil fuels, is called gray hydrogen. If carbon capture and storage is used together with fossil fuels, then it becomes blue hydrogen. If nuclear power is used, it's called pink. And finally, green hydrogen is when it's produced via electrolysis and powered from renewable sources. This method is considered emissions-free. It's predicted that by the early 2030s, H2 made from renewables will be cheaper than that made from fossil fuels. But that hinges on the cost of electrolysis declining, which will be achieved through larger projects and an expansion of manufacturing. To be clear, vast amounts of H2 are already used today. Global production in 2018 totaled 117 million metric tons. This hydrogen is mostly used for its chemical properties, not as a source of energy, and very little of it is clean. Some sectors like steel could start using hydrogen for these chemical properties, replacing coal. Industries like cement and glass may also use hydrogen as a source of heat. Another advantage is its energy storage potential. It can be stored over long periods of time and used when more power needs to be added to the grid. It also could hold an advantage over batteries in heavy transport and shipping. The promise of hydrogen for energy has been around since at least 1874, when Jules Verne wrote about it in his book, The Mysterious Island. But the future of hydrogen will depend on policy. Countries with net zero targets, carbon pricing, and hydrogen strategies with investment mechanisms are likely to see the highest H2 demand.
That was Bloomberg's Christine Lee Edwards explaining what hydrogen means for the energy transition. But how are businesses approaching the sector? Well, one of Australia's richest men is making a big play into hydrogen. Andrew Forrest, better known as Twiggy, made his fortune from iron ore, being the chairman, former CEO, and major shareholder in Fortescue Metals, one of the world's biggest miners. But after having made over $10 billion in profit from the metal in the last fiscal year, Twiggy wants to transform Fortescue into a clean energy company. He's been scouring the planet in search of investment opportunities in hydrogen and renewables. The firm plans to allocate up to 10% of its annual profits for green energy investments and is exploring projects across the globe, from Indonesia to Argentina. Francine Lacqua caught up with Twiggy Forrest.
There's only one type of clean hydrogen, all the rest is dirty.
Yeah.
That is green. If you just say green hydrogen is clean, the rest is dirty, then you've actually nailed it. And, you know, anyone else who produces any other rubbish, any other argument, just look them there and say, why is global warming accelerating if anything you're saying is true? And then you'll know, actually, it's greenwashing.
Yeah, but there's a lot of greenwashing because I keep on being told it's a transition. We can't just, make the transition at a click of a finger. So what are we doing wrong? What can we do better?
I don't remember the personal computer having to transition the typewriter. I really don't remember that. I don't remember the smartphone having to transition the pocket calculator and the old landline. You know, its transition line is complete rubbish. The lie got put to it 2 days ago when JCB, a really loved British company, every right for the country to be part of JCB, and Fortescue, holding a bit of a similar reputation, fantastic track record, everyone's done super well from Fortescue, huge balance sheet, super strong. When those two companies got together and agreed a $79 billion US agreement per annum, right, then that's a real wake-up call to say, hang on, green hydrogen is obviously commercial now. You know, every other form of fossil fuel hydrogen, you know, it can compete with it on price, it can probably lose on price, but what we know, it is cooking the planet. And only green hydrogen zero methane, zero carbon in the supply chain. Don't worry about the molecules in the supply chain.
But at the moment, we're not even phasing out coal, if you look at the G20 communique. So we have a long way to go to talk about only using green hydrogen.
Yeah, so look, I have a call, which I'd like to make now, that the world should not fund any more coal-fired power stations, coal mining projects, ever. We should wind them down as quickly as possible because they are cooking the planet just like grey and blue hydrogen is cooking the planet.
Yeah.
You know, hydrogen, which is not made from renewable electricity, is releasing 10 to 16 times more carbon, let alone the methane, which is worse, than it is hydrogen. So we've just got to stop doing things which are self-harming under the guise of greenwashing.
So why are leaders so slow? Even if you look at the appetite for ESG investments, they're growing exponentially, so are emissions. So where are we allocating capital?
Okay, so take the recent G20. There's probably a reason why there wasn't strong action coming out of the G20 because people were not aware that major transactions between large companies were taking place now on green hydrogen, that actually this pollution-free all the way through the supply chain fuel was now being transacted at multi-billion-dollar scale. If they'd known that, I don't believe any sovereign leader or any energy minister or climate change minister could not take ultra seriously that green hydrogen is now here to stay. It's broken through. History has been made. It will never go back.
Okay, what is the one thing that you would tell leaders today and business leaders? How do we transition faster than what we are now because we're at real risk of missing our targets?
Oh, so that's really simple. You stop funding, you stop subsidizing, you stop using money into fossil fuels. It could be carbon sequestration, it could be fuel rebates, could be anything. Hundreds of billions of dollars getting ashed while we ash the planet on fossil fuel subsidies. Because we haven't had that renewable electricity, we haven't had that green hydrogen, it's kind of been pushed down. It's all sorts of excuses. Oh, it'll never be commercial, it'll never be supplied in the quantities we need it, blah, blah, blah. Now we know, let's take action. It's practical, it's implementable, let's do it now.
Okay, if we do it now, is there going to be a shock to the energy system? Is there going to be a shock actually to economically? And is it worth, not talking about transition, just going from A to B?
Yeah, it's a fantastic question. A to B is the solution. Let fossil fuels do what fossil fuels do. Just burn their coal, burn their oil, burn their gas. At least they're pumping up carbon and methane into the atmosphere, honestly. Well, not that honest because they don't measure methane, which is 90 times worse than carbon. But at least the carbon is being done honestly. Encourage the green hydrogen sector to come in really fast. Okay, it's there. There's renewable power all over the world. We now know how to make electrolyzers much cheaper, like 25% of the original cost. We know how to do that now. We don't have an excuse to get into it.
Does it need to be cheaper than oil and fossil fuel for it to be viable worldwide?
Well, right now it is. Okay, so let's just swallow that bit of financial data. Right now it is cheaper, and it's getting more cheap. It's the only fuel you know of which is declining in value.
You don't have enough of it, right, to power the world.
Yes, that's only because we haven't had policies to support it. If we had policies to support it 5-10 years ago, it would be everywhere. You'd see the global warming budget start to come down. Now, we've got 5 or 10 years to make a huge difference. I need policy leaders all over the world to appreciate now, okay, big business is transacting with green hydrogen in multi-billion-dollar agreements. We now know it's here and it's here to stay. Let's spread it everywhere.
Coming up on the program, the hydrogen revolution. We'll speak with the CEO of Italian utility firm Snam about his new book and why he thinks green hydrogen will be competitive in just 5 years. Plus, how are airlines working to become more sustainable? We'll look at how Airbus plans to step up in the climate fight. This is Bloomberg Green. From Bloomberg's World Headquarters in New York, I'm Kaylee Lines, and this is Bloomberg Green. What will the world look like in 2050? Will global temperatures have stabilized, electric vehicles be abundant, and solar and wind power homes around the world? According to Marco Alvera, the CEO of Italian energy company Snam, that vision of the future could be a reality. And he says that hydrogen will pave its way. As he tells it in his new book, The Hydrogen Revolution, Alvera's moment of reckoning came in November 2018 when he tasked the Snam Scenarios team with studying how Europe could reduce its CO2 emissions to zero by 2050. Looking through the results of the study, Alvera said he was struck by how much hydrogen was in Europe's energy mix by that year. Beyond the abundance of hydrogen, the SNAM model also predicted that it would be the cheapest form of decarbonized energy for many sectors, and that it could be cheaper than today's prices for oil, coal, and nuclear power. Our Maria Tadeo spoke with Alvera at COP26.
It's happening all very fast. We see the cost of hydrogen coming down a lot. Hydrogen will play a big role in the energy mix. I don't know if it's going to be 15 or 25% of a fully decarbonized energy system, but it's going to be big. Costs are coming down, and people are waking up to the fact that it's the only way to decarbonize certain sectors, so-called hard-to-abate sectors.
And you say it's the only way and the costs are coming down. Where do you see prices moving? Because a lot of the reticence at times has to do with the pricing, that some argue, well, it's still not the cheapest option on the market.
So when I was first working in hydrogen in 2004, it was costing $1,000 per megawatt hour. 2010, $600. Today, $100, and we see it going down to $50 in 5 years' time, and to going down to $25 per megawatt hour in the next 10 years or so, which is a quarter of where it is today. That's really because renewable energy, and we're talking green hydrogen here, renewable energy costs are falling, but the cost of making the electrolyzer, which is the kit that you use to convert solar or wind energy and water into hydrogen, the cost of this kit is falling a lot because it doesn't really exist on an industrial scale. So as we build up capacity, we industrialize it, we standardize it, and we squeeze costs out. That's really the cost trajectory.
And for that, of course, you need demand, however, for governments and also institutions to kind of buy into this idea that it is the future and we want to invest and create infrastructure. What are they telling you? When you speak to governments, when you speak to officials, are they keen on this?
They're very keen. So the Department of Energy shares our view in the States of getting to below $1 a kilo, which is $25 a megawatt hour. The European Union has a hydrogen strategy, which is very clear, and several member states have the same. Chile wants to export a lot of hydrogen. China's big on hydrogen. Australia's very big on hydrogen. Japan is blending already hydrogen. So I would say the world is now really focused on this because it's the only way to store energy for a long period of time economically is to convert it into either a liquid or a gas.
And of course, you talk about the price, but the other big component is the volume. You know, how big can you go? Where do you see that on a time scale?
So wherever it's sunny or windy, you can produce very cheap hydrogen eventually. And so compared to oil and gas, which are concentrated in few parts of the world, it's going to be very democratic from that point of view. So every sunny place, every desert, every ocean wind can be turned into hydrogen that we can put on ships, in pipes, and really start trading it around the world. So it's going to happen a lot faster than a lot of people think.
So, and when you say a lot faster, what is that in time?
As I said, $50, which is essentially oil parity within 5 years. And then, depending on how quickly we ramp it up after that, we could get to $25, which is coal parity before the end of the decade.
And in big scale.
In big scale, because once you get to coal parity, that's the only way we're going to get China and India to stop burning new coal. We have businesses in China and in India, and I see a lot of hydrogen development, a lot of renewable development in both countries. The India announcement was incredibly strong on 2030. Some people were upset about the 2017 net zero deadline, but when it comes to 30, he announced a big, big commitment to get to 50% renewables.
Were you surprised by it?
I was surprised that they would make it so explicit, and even the net zero is a big thing for them. And so I think it will happen faster than 2070 because of the falling cost of renewable and hydrogen. India's burning 80 gigawatt of oil, of diesel, to keep the lights on. So there's an immediate opportunity there, and we're very interested in working in that country.
And with regards to China, perhaps the fact that we haven't really seen them active, I guess the diplomats are working on this, but we haven't really seen the leadership.
It's going to be technology, it's going to be industry. I think China has committed to a net zero, which is very important. At the G20, China was clearly behind the 1.5 degrees. So I think a lot has been achieved between the G20 and COP, and I think what's really important is to see in the coming years how quick it's in our hands to make part of this happen in 5 years, or it could otherwise happen in 15, 20 years. It's about building the project. The capital is there. We saw how many trillions of dollars are already committed. What's missing is really the projects, and that's where companies like us step in.
Marco Alvera, CEO of SNAM there, speaking with our Maria Tadeo. Let's turn now to the aviation industry. It's a big contributor to global greenhouse gas emissions, and it's under pressure to change that. In October, the International Air Transport Association, a trade body representing airlines, approved a target of achieving net zero emissions by 2050. To achieve that, many airlines in the US and Europe are looking to buy sustainable aviation fuel made from renewable sources like used vegetable oil. Initiatives like these are pushing plane makers to come up with some radical new aircraft that will eventually cater to our growing appetite for travel without hurting the environment. We took a look at how Airbus, the world's #2 aircraft manufacturer, is stepping up to the challenge.
How long until we can fly emission-free? Airbus says it's more confident by the day it can be done by its 2035 target. Airbus's CEO spoke about its ambitions for hydrogen-powered planes at the company's summit in France.
The physics works. Hydrogen technologies are not new. They are used in other sectors. We use them in space on our rockets, and we don't need the laws of physics to change to be able to use hydrogen on our planes. So every day we become more confident, but we think we need to have a plane, we need to have the right fuels, the hydrogen available in the right quantity at the right place at the right time, and we need the regulations to be ready. So we really need the work and the collaboration of many people around the globe to make it happen on time.
But it could be a long wait until green passenger jets go mainstream. Larger aircraft with more than 150 seats are not expected to feature globally until about 2050. That means manufacturers and airlines today are under growing pressure to ramp up short-term innovations to cut their carbon. In the long term, meeting the ambitious plans for so-called green hydrogen means building a giant industry almost from scratch. To make that happen, British airline EasyJet is among those saying governments need to get involved and fast. Aviation's emissions over the last 3 decades leading up to the pandemic grew by about 80% to over 1 gigaton, and that's projected to double by 2050. According to Bloomberg NEF, about half of the airlines with the largest global market share have set net zero targets by that same date, nearly 3 decades away.
Coming up, from blue sky projects to the bottom line. We'll speak with our Bloomberg NEF expert Meredith Annex and dig into their models about how hydrogen fits into the future energy mix. This is Bloomberg Green. Bloomberg's World Headquarters in New York, I'm Kaylee Lyons, and this is Bloomberg Green. Now let's bring in Meredith Annex, our Bloomberg NEF hydrogen specialist, to talk more about how hydrogen could change the energy landscape. So Meredith, what place do you think hydrogen is likely to have in the future energy mix globally?
Hydrogen's this incredible solution for us as we look to decarbonize because it's a perfect solution in areas that are hard to electrify. So where we like to think about hydrogen playing a role, it's in things like heavy industry, especially where you need a feedstock as well as energy source, and in things like dispatchable power, long-haul transport, maybe even shipping and aviation.
That sounds great that it can be used for such diverse industries. At the end of the day, though, how much is this going to cost?
Well, that's the amazing thing about hydrogen, because depending on how you make it, it can actually see significant cost declines in the future. So when we're talking about clean hydrogen, we usually mean green hydrogen produced from renewable electricity. And in that case, your hydrogen is almost as cheap as the renewables that are used to make it. So if you're in a place with really good renewable resources, you'll be able to have cheaper hydrogen. But even in places with less good resources, we think that hydrogen can be cheaper than $1 per kilogram, which is the price of unabated hydrogen today, and around $8 per million BTUs for those who prefer to think in energy units. And that can be achieved anywhere in the world by 2050, we believe.
All right, so let's talk about kind of the pros and cons list. I don't know where cost fits into that, but what are the advantages to hydrogen over other renewables, and then what are the drawbacks?
Yeah, main advantage is the fact that hydrogen can serve roles that electrons struggle with. And that's things like seasonal storage, for instance, or just anything where you need storability, where electrons are harder to store, hydrogen is going to be easier. That also leads to a downside, though, because hydrogen is less energy dense than the usual things that we use for storable energy today, like coal or oil or natural gas. So you will need more volume of storage to handle the same amount of energy.
Let's talk about the viability as well and how it may differ in different geographies. What is your view on that?
Yeah, so for green hydrogen, again, from renewable electricity, really places with the best renewable resources, things like Latin America or the Middle East, even Southern Europe, have really, really good potential for producing hydrogen. And then when you're looking at blue hydrogen, which is produced from natural gas or coal with carbon capture and storage, we do see that becoming more expensive than green hydrogen in the future, especially as renewable electricity costs come down. But that can be a viable option in places like the US Gulf Coast or Russia, where you've got good geological storage for the carbon, as well as ample natural gas that's quite cheap.
All right, great breakdown. Thank you so much to our Meredith Annex, our Bloomberg NEF hydrogen specialist. And of course, you can get more from the Bloomberg NEF team on the terminal and online. And they've recently done a podcast called Hydrogen 101 as part of its Switched On series. So from iron ore titans pivoting to cleaner energy to talk of a hydrogen revolution, that's it from this week's edition of Bloomberg Green. We'll be back next week with a deep dive into the state of electric vehicles. And you can keep the conversation going by following us on YouTube, Instagram, and Twitter @Climate. I'm Kaylee Lyons from Bloomberg's World Headquarters in New York, and this is Bloomberg Green.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World headquarters, I'm Charlie Pellet. Stocks are fluctuating. We've got the Dow higher, S&P, NASDAQ, both lower. Truth be told, S&P right now flat on the day. Oil has halted its surge amid intense volatility as investors weigh the economic impacts of the war in Ukraine. S&P little changed after dropping almost 1% earlier in the session after a weak U.S. services reading. Right now, the S&P is up by 1 point. The Dow is up by 90 points, up 0.3%. NASDAQ, though, remains lower, down 122 points, down 0.9%. And the NASDAQ 100 index down now by 0.8%. Russell 2000 lower by 1%. Dow Transport's up by 0.6%. 10-year yield 1.85%. Spot gold up 0.3%. $19.34 the ounce. West Texas Intermediate crude down 0.9%. $109.63 a barrel on WTI. Brent down 0.5%. Barrel of Brent right now is at $112.33. Wall Street is looking ahead to tomorrow morning's jobs report. Claims today decreased by 18,000 to 215,000, lowest level since the start of the year. As for the claims data and where the economy now stands, Neela Richardson is chief economist at ADP.
We are an economy that has the absence of a high degree of federal spending and monetary easing that is going to fade away. So, yes, healthy economy, and those jobless claims are another good sign, how far we've come in the labor market. But we should see some slowing growth, and the real battle now, the real issue now, not the battle, the issue now is inflation.
JP Morgan Chase says Brent crude could end the year at $185 a barrel if Russian supply continues to be disrupted. Among oil stocks today, ExxonMobil up 0.6, BP down 4.3%, Chevron up 1.2%. And that's a Bloomberg Business Flash.
This is Bloomberg Business Week. Insight from the reporters and editors who bring you America's most trusted business magazine. Plus, global business, finance, and tech news as it happens. Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
Live from the Bloomberg Interactive Brokers studio, we are streaming on YouTube. It is Thursday, March 3rd, 2022. Carol Masser, along with Bloomberg Quick Takes Tim Stenovic, and we have a lot of headlines crossing.
Yeah, we certainly do. We also are watching stocks that are off their lows amid ongoing volatility into financial markets on a second consecutive day, hearing from Fed Chief Jay Powell. We're going to have more in a moment from Kriti Gupta and Mike McKee.
Mentioned headlines. We do have the U.S. punishing Russian oligarchs over the invasion of Ukraine. So we are increasingly seeing that financial sector and financial individuals, or individuals with a lot of finance at stake, certainly being targeted by the world when it comes to sanctions in response to the Russian invasion of Ukraine.
Well, that is the cover of the new issue of Bloomberg Businessweek magazine. It's all about the battle that's raging on in Russia's financial front in response to its invasion and the war against Ukraine. We're going to have more on that and how the crackdown on Russia's economy could have consequences that last decades.
Plus, we'll also take a look at the plunge in shares of a company that has included Berkshire Hathaway among its top investors. We've got Broadcom earnings after the close, and then we're going to check in with the head of Bowdoin College. They've got an interesting partnership.
Yeah, you want a new MacBook Pro?
Who doesn't?
Yeah, that and a tuition at Bowdoin will get you, one of those.
All right, we're going to shelve that for a moment. All right, let's get to the Market Drivers Report. Let's set that Business Week agenda on this Thursday. In the house, Kriti Gupta, markets correspondent at Bloomberg in our Interactive Broker studio. So too is Mike McKee, international economics and policy correspondent at Bloomberg News. Going to get to the markets in just a moment, but I do feel like these last 2 days have belonged to Jay Powell and the Fed and what he had to say. Mike, what's key here? Second day, got a lot of the same stuff?
And that Putin guy played a big role
and
today.
That Putin guy.
Today was pretty much the same as yesterday. Powell went out yesterday with something to say. He wanted to let the world know, let Congress know that they're going to raise rates this month and that he thinks it should be 25 basis points. And what the Fed chair wants. The Fed chair is going to get. He also wanted to send a message to the hawks on the committee that he's listening to them. The 50 basis point argument isn't completely ridiculous, and we can talk about it. And then he wanted to prepare the American people for the idea that we're going to have inflation for a while because of this. It could slow the economy down. We're going to do our best. So today was just kind of a repeat of that. They got into a few of the minor issues that come up in the regulatory sense, but most of it was about policy.
Well, Mike, that's what I wanted to focus on was the inflation side of this, because if we think back to just a few months ago, we were still using the T word, transitory, when it comes to inflation. What did Powell say about inflation today and about how Americans should get used to rising prices and perhaps the timeline for when those rising prices will ease?
Well, he did for the first time seem to admit the idea the Fed got it wrong with transitory, not because they were stupid, but because they were relying sort of on a mental model.
Here's a little thing. I think almost everybody got it wrong.
Yeah. Well, the Republicans would have you believe, at least the Republicans on the committee questioning him would have you believe it was all his fault. But basically, he said, in hindsight, we would have started earlier if we knew this was going to happen. And so he's basically saying we're going to have more months of higher prices, primarily because of oil and energy prices are going to be higher, and because the war is probably going to create more bottlenecks, more supply chain problems, and that'll push prices up. What'll be interesting is the March 16th meeting, they do their next set of forecasts, and they, remember, we're forecasting that inflation would get down to just about 2% by the end of this year.
Right.
And so obviously they're going to have to mark that up, and he didn't give us a number today, but he said, you'll see a higher forecast.
All right, Creedy, so come on in. Markets, how are they reacting to all of this that's going on?
They are so weird. Can I just say that? Weird is a technical term, by the way. The S&P 500 is flat. It started off in the green. It completely dropped in the middle of the session. And now it's kind of paired some of those gains and come back. And it all comes down to what's happening in the oil market right now. Because every time oil moves up or down, you see the stock market have a very direct reaction. And that's going to be really key because you have Brent circling $112. And really you have Brent now flat, but essentially dropping from being even higher today simply because this idea that an Iranian supply could hit the market. So the market, the oil market, is still kind of digesting how this is all going to, what this is all going to mean. Is this going to offset some of the pain you're seeing from that Russian supply? And the stock market is saying, I don't know what's going on, but we're going to keep an eye on those oil prices. And this is, I have to say, a very stark contrast from when the stock market was taking its cue directly from the bond market. It tells you where the investor focus has shifted somewhat away from Chairman Powell, and that now he's talking about a 25 basis point hike in March. It's something that's kind of priced into the market at this point.
I mean, yields have moved up again, right, from some of the lows we saw earlier in the week?
Well, only by a
bit?
few basis points.
Okay.
They're still way down. But I think Creedy's right, that people are going to move on from Powell now. We kind of know what the Fed's going to do. And now it's going to be all about what happens in Ukraine. And I saw an interesting comment today, Creedy, from some investor who said basically, watch out for tomorrow, because nobody's going to want to go long into the weekend.
Yeah.
Because there's anything could happen.
Yeah.
And we would joke and say anything could happen short of nuclear war, but even that could happen.
Which we did see last weekend, right? Because didn't we see buying into the weekend?
After like 4 days of selling.
Fair,
which is,
fair to be fair.
yeah.
But, I was surprised to see that, that
And it happened like the last hour of trading too, but that's purely technical kind of stuff. That isn't fundamental markets. And if I'll just, last thought here is, this is what happened during the trade war. Remember, Trump would tweet on Friday, we'd get a response from Xi Jinping on Sunday, and people wouldn't go long into the market.
You know what's funny?
What?
Tomorrow's Jobs Day, and you haven't even asked me about that.
I was just going to say we can't.
415,000. That's
we
the
can't
number.
leave without mentioning jobs. So, just quickly.
I saw a great line today that NFP stands for not focused on payrolls.
We have to use that.
Everybody's going to look through this. I mean, we'll take some information from the wages and the participation rate, but now it's all about the inflation numbers.
All right, there it is. Yeah, 415,000 is the number that's
NFP.
expected. Yeah.
Right?
Not focused on payrolls.
But that's been our environment. Like, it's amazing that there can be such a big thing going on, and because there's another big thing going on, we can we're also in a pandemic still.
Just wait till the next inflation print, right?
Short attention span theater, as they say.
Yeah, exactly. Thank you, guys. Well set up, and we know these guys are going to be crazy, certainly because of that jobs report, which we will pay attention to, and we'll see what kind of market reaction. Our thanks to Kriti Gupta, markets correspondent at Bloomberg, and of course to Michael McKee, international economics and policy correspondent at Bloomberg.
Let's go to Washington, D.C. for a check of the latest world and national news with Nancy Lyons. Hey, Nance.
Thanks, Tim. Mounting sanctions on Russia do not appear to be deterring the war in Ukraine. Russia claims that it's taken the southern port city of Kherson and is making its way to Odessa on the Black Sea. At the same time, that 40-mile convoy heading toward the capital, Kyiv, appears to be bogged down. Bloomberg's Rosalind Matheson has the very latest.
Still no movement closer to Kiev, the capital, even though there's been shelling overnight in both the capital, Kiev, and the second biggest city in Ukraine, Kharkiv.
Bloomberg's Roz Matheson. Ukrainian and Russian diplomats met again today and now say a third round will be held. After today's talks, Ukraine said it agreed with Russia to create safe corridors to evacuate civilians. Lawmakers say they may have evidence that former President Donald Trump was part of a, quote, criminal conspiracy to overthrow the 2020 presidential election.
The House committee investigating the January 6th insurrection says Trump advisor John Eastman's emails to Vice President Mike Pence's lawyer include evidence of a crime by trying to prevent Congress from certifying the 2020 election result. In a court filing, the committee says Eastman knew what he was proposing would violate the law, but pushed the vice president to do it anyway. It is the first public signal that the committee is looking into criminal activity by those within Trump's inner circle. In Washington, I'm Amy Morris, Bloomberg Daybreak.
The CDC is no longer recommending contact tracing to contain coronavirus. Instead, it's pushing health departments to just focus on high-risk settings like long-term care facilities, jails, and shelters. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Carol Master, Tim Stanovic, we are live in our Interactive Brokers studio here at Bloomberg headquarters in New York City. So popping up on our radar is a story about the Florida governor, Ron DeSantis. He is using a viral video of him chiding mass students. My husband and I were talking about this.
You saw this viral video last night, too?
I haven't seen it, but we were talking about it. But anyway, he's using this video of him chiding mass students to solicit campaign contributions.
Right, so here's what he tweeted out earlier today. The video the video circulated online last night. That's when I saw it. But he writes today, quote, "The political science show cannot go on." He tweeted Thursday from his political account with a campaign-style video that criticizes Democrats who've been seen at recent public events without masks. He writes, quote, "It's curtain call for COVID theater."
Right, exactly. He said, "I told a group of students masks were ridiculous. They didn't have to wear them if they didn't want to." He said this in that campaign email that was sent today, asking for contributions of $15. Predictably, the leftist propagandists in our media had a meltdown and called me a bully for allowing children to breathe fresh air. This is what the governor said.
Yeah, this is what the governor said. In the video, I'll explain it, the way that I saw it. There's these students on stage at a lectern, and he comes up, and they're all wearing masks. He comes up to speak. He's not wearing a mask, and he turns to them, and he's like, "You guys don't need to wear masks." And the students kind of look at each other like, "Wait, should we take these off?"
Some of them did.
Some of them did take it off, but some left it on, and it was kind of awkward.
Yeah, this is the... Speaking of awkward, I had to do a work trip yesterday. It landed in Chicago.
Got to do a work trip.
Got to do it. It was a lot of fun to be out on a plane, out in the field, working with a crew. What I will say is when I checked in Tuesday night into my hotel, I go up to the hotel and nobody has masks on. And apparently just the day before, the mask mandate had been stopped. And I was like lost. So I'm putting my mask is on.
Interesting.
I'm like, do I pull it off? I had it on, off. Like it was weird. Airplanes still masks, Uber still masks.
That's what I'm waiting to see. When the mask mandate's lifted here, do people keep masks on because they're used to it and because they feel safer doing so?
Gotta say, I'm still, I'm relying on my community to do the right thing, and that's not always a good thing you can do.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. The Dow, the S&P, they're pushing higher. NASDAQ on the minus side. Bottom line here, stocks are fluctuating. Choppy session, oil halting its surge amid intense volatility as investors weigh the economic impacts of the war in Ukraine. S&P up now by 10. That is a gain of 0.2%. The Dow up 160, up 0.5. NASDAQ down 96, a drop there of 0.7%. 10 years up 430 seconds. 10-year yield 1.86%. Spot gold up 0.3%, 19.33 the ounce on spot gold. West Texas Intermediate crude retreating today by 1%, still with a 109 handle, 109.45 right now on WTI. Barrel of Brent down 0.7%, 112.16 a barrel on Brent. Natural gas higher, up by 0.4%. Bitcoin slumping 3.9% right now, 42,372 on Bitcoin. After earnings, Best Buy shares surging. Best Buy up now by 11%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Charlie Pellet there. Well, a story on the Bloomberg about the Omicron variant being much deadlier than the seasonal flu, why that's important to remember, and also why it's also important to remember that there will be a next pandemic. It's the subject of a new book by Bill Gates, by the way, and that's something that's highlighted in the Pursuit section of the current new issue of Bloomberg Businessweek magazine. We talked about it with Chris Rausser. That'll be in our weekend show.
Well, Dr. Andy Pekosh is professor of molecular microbiology and immunology at the Johns Hopkins University Bloomberg School of Public Health. The Bloomberg School of Public Health is supported by Michael R. Bloomberg, founder of Bloomberg LP and Bloomberg Philanthropies. Dr. Pekosh joins us once again on the phone from Baltimore. Dr. Pekosh, how are you?
Doing well. How are you all?
We're doing well. Carol and I were talking earlier about the mask mandates being lifted in different parts of the country, and indeed, it's something that's going to be happening in New York. Friends texting me in the last few days that their kids are no longer masked at school, and my friends are pretty appreciative of that. When you take a look at where the United States is, how would you describe it?
Well, you know, everything's trending in the really good directions. In some parts of the country, case numbers are still a little bit higher for my tastes, at least to be able to relieve a lot of the public health interventions, but everything is looking like it's moving in the right direction. No new variants that are of high concern.
Fingers crossed.
Are coming down the pipeline, at least immediately. So I think we're in a really good place right now for most of the population. I guess I would say the exception would be, you know, the people who are highly susceptible to severe COVID, the elderly, those with compromised immune systems. Those are populations we still need to monitor carefully because COVID can be such a severe disease in those populations. But for most people, things are trending in the right direction.
But we do need to, I'm sorry, go ahead, Tim. Please.
Well, I was just wondering, you know, you said case numbers are still too high for you to be comfortable. What is that number that you'd like to see for you to say, okay, wait a second, we're no longer in a pandemic, this is now endemic? Because we are still seeing tens of thousands of new cases every day.
Exactly, and I think you have to look locally to see how your spread is locally. One good parameter rate is if your test positivity rate is about 2% or so.
Okay.
That really tells you that two things are going on. Case numbers are low, and you've got enough testing going on to really be confident that you're detecting a lot of the cases out there.
What's interesting, too, is, and I do think about this, as I said, I was like perplexed landing in Chicago Tuesday night, getting into a hotel outside of Chicago, and nobody had masks on because they just pulled the mask mandate. And I have to say, Dr. Pekosh, I was like, I didn't know what to do. I had my mask on. I left it on. I felt awkward. People were like, oh, cute mask. Like, and nobody else had a mask on. But I have to rely on my community to do the right thing. And we know that unfortunately, our community hasn't. So what's your advice to us increasingly as we go forward with this? And what are the numbers that you're going to be watching that we don't? Is it just a case of an uptick of cases that will remind us that, you know, it's still not completely safe?
Well, you know, the CDC recently updated their guidance for mask wearing, which is what really precipitated all of these mandates being relieved. You know, I think, number one, you should always go with how you feel in your conscience. And if you're not feeling comfortable going out without masks, please mask up. I still mask up when I go out to groceries, shopping, and other places as well, too. I think there's nothing wrong with masking up. wearing a mask for yourself is still good for protecting you, and I think that's something everybody should feel comfortable doing if they want to. I'm hoping that what we're going to see now is that COVID becomes a bit more seasonal. So as we get to warmer weather, it'll be less and less likely that we see significant surges of cases, so that we'll really be in a period of time now where we can be a little bit more comfortable that conditions won't be ripe for large surges of cases.
So, okay, well, let's talk about those conditions. Carol mentioned Bill Gates' new book that's reviewed in the upcoming issue of Bloomberg Businessweek magazine. We've talked a lot about it, the idea of the next pandemic. But before we get to the next pandemic, I want to think about the next variant. And I want us to have a realistic set of expectations, because I remember how I felt in June of 2021 when I went to a wedding and it seemed like COVID was absolutely gone and we had turned this corner. And then, a few days later, boom, Delta variant. We get out of the Delta variant, boom, it's the Omicron variant. How should we be planning for our own futures, just in terms of risk taking and setting expectations? So, I'm not slapped across the face again.
Right.
Yeah, I think what SARS-CoV-2 has shown us is when it entered the population 2 years ago, it was a virus that could spread well, but it really wasn't optimal for infecting people. And what you've seen now, maybe with Omicron as the pinnacle, is this virus really adapt to be able to infect and spread in the human population. So it will be here. We will see continuing variants emerge because that's what viruses do. They mutate, and if they mutate in a way that makes them better at infecting people, then they will become the dominant virus. But the most important thing is we have now vaccines that induce population immunity. Now, that's different from herd immunity. Population immunity just means that we're going to dampen disease severity, we're going to dampen numbers of cases a bit, and we're going to be able to reach an area where we can control the numbers of cases through vaccination and treatments and avoid those severe cases. And that's where I hope we're going to be, particularly in a few months, because as more treatments come on board, as people get hopefully a little bit more comfortable with vaccines and taking them, we will be able to get all of this population immunity together that's going to really minimize the threat of severe COVID for most of us.
We know it's not, though, equal or the same around the globe. And I do think about as people are increasingly getting back on planes, myself included, especially when it comes to international travel, is there the possibility, is there the likelihood that we will see outbreaks again?
Absolutely, and I think we're seeing them right now in places like Hong Kong, New Zealand, Australia. Some places are seeing increased numbers of cases because the virus, particularly Omicron in this case, got there later and is starting to move forward later.
Dr. Pekash, forgive me, we've got to head to the White House. We really appreciate your input. Let's go to President Biden, a playback from some recent comments on the war in Ukraine.
In the State of the Union address, I announced that the Department of Justice is going after the crimes of Russian oligarchs. The Attorney General spoke to that earlier, and who line their pockets with Russian people's money, and while Ukraine and the people are hiding in subways from missiles that are being fired indiscriminately in Russian cities. Today I'm announcing that we're adding dozens of names to the list, including one of Russia's wealthiest billionaires, and I'm banning travel to America by more than 50 Russian oligarchs, their families, and their close associates. And we're going to continue to support Ukrainian people with direct assistance. I had a meeting this morning with the quartet down in Southeast Asia, including India and Japan. And we're going to continue to support the people with direct assistance. And on Tuesday night at the Capitol, we saw America united in support of Ukraine and in our work to hold Putin accountable. And now to today's meeting, we're going to discuss how we're going to keep the economy growing by bringing costs down for the American people, as well as we know that people are feeling the pinch. And we're going to do everything we can to make everyday things more accessible and more affordable for the American people. And we're also going to discuss the unity agenda I announced, and there was broad bipartisan agreement, trying to end the opioid epidemic, ending cancer as we know it, providing support for veterans and mental health, especially for our children. response, as you all know, because I've read your polls, has been overwhelming on all four of those issues, and because they're of great concern to the American people. And today, I have progress to announce on two of them. Just this morning, the House passed a bill to provide health care to veterans suffering from toxic exposure like burn pits. And 34 Republicans joined with Democrats to make bipartisan progress on this project, keeping our sacred obligation that we have to veterans who, when we send to war and they come home, we care for them. And when it comes to the mental health of our children, today I'm instructing the Departments of Education, Health and Human Services to develop initial guidance to schools that will help them provide mental health support for students in our schools. And this is going to include enabling schools to use Medicaid funds to deliver those important services. And because to me, the State of the Union was more than a speech to me. It was an action plan to lower costs, to address our critical needs, and as for the American people, because they're confused out there, understandably. The world is changing so rapidly. And we have a lot to cover in this meeting today, but I'm going to invite my friends in the press to depart in a minute. But the bottom line is, I meant what I said when I said I'm optimistic. I'm optimistic if we use the kind of ability to unite the country I think it exists, and I think we saw at the State of the Union. I don't think there's anything we can't do. I really don't. And we are at one of those inflection points in world history where we have an opportunity. If we act swiftly and we act with courage, we can change the dynamic the world is moving to. If we don't, we're going to be in real trouble. And but I think it presents an opportunity as well as a problem. Like I said, my mother used to always say, out of everything bad, something good if you look hard enough for it. And we're looking hard, and I think we found some answers. So anyway, thank you all for being here, and we're going to get on with the meeting. Thank you.
Thank you, guys. Thank you. Let's go. Thank you. Let's go. Thank you, guys. Thank you. Let's go. Come on. Let's go. Thank you. Let's go. Come on. Kristen, let's go. Kristen, let's go.
All right, you've been listening to President Biden. That's a playback from some recent comments he just made in the cabinet room with his cabinet members. He is holding a cabinet meeting. Among the headlines from those comments that you just heard, he talked about the sanctions on Russia having had a profound impact. He also talked about banning travel to some 20 Russian oligarchs to the U.S. The U.S. saying it would sanction 8 wealthy Russians and their families. That includes President Vladimir Putin's press secretary, also limiting the travel of 19 others and 47 of their family, as we increasingly see the West working to raise pressure on the Russian president and those closest to him. The president then talking and addressing some domestic issues that he had brought up in his State of the Union, talking about health care to veterans exposed to toxic materials, also mental health, providing for that in schools around the United States. So again, that was a playback cabinet meeting at the White House from President Biden. All right, right now, though, let's get back to the markets and get a quick check on the trading day. We're definitely bouncing off our lows on those major equity averages. For that, let's head on over to Charlie Pellet.
Hi, thank you very much. And here's what's going on, Carol Master. We've got the Dow higher, the S&P higher, and NASDAQ does remain lower. Stocks, as you mentioned, fluctuating. Oil has halted its surge amid intense volatility, with investors weighing the economic impacts of the war in Ukraine. Right now, we've got West Texas Intermediate crude oil falling by 2.4%, down $2.65 a barrel, now at $108.05. Brent crude down $2.19 a barrel to $110.74, a drop per barrel of Brent of 1.9%. 10 years up 7/30 seconds, 10-year yield right now 1.85%. NASDAQ down 116, down 0.8%. S&P up 4, up 0.1%. The Dow up 123, higher by 0.4%. So we have been seeing big moves in crude oil, higher for most of this week, lower today. Peter Cicchini is Director of Research at Exonic Capital, and he says when it comes to commodities, it's not just things like oil and wheat.
Neon is another commodity that comes out of the Ukraine. You might say, well, who cares about neon? No one uses neon signs anymore. But neon happens to be an important component of the lasers that etch chips. And while less dependent than it was 10 years ago on neon out of the Ukraine, the industry is still dependent on neon. And of course, we all know that that industry is already dealing with shortages and supply chain issues.
And the Philadelphia Stock Exchange Semiconductor Index, also known as the SOX, which is made up of 30 companies with names like Micron, Lattice, and Intel. Today, we are seeing the SOX. It is trading lower right now by 1.3%. Best Buy shares higher after unveiling an upgraded long-term forecast spurred by investments in a membership program, remodel stores, and new services. Best Buy shares up right now by 11.2%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. Well, as we just talked about, the world increasingly sanctioning Russia following that invasion of Ukraine. We just talked about the U.S. Adding sanctions to Vladimir Putin's press secretary, limiting the travel of 19 others in terms of Russians and 47 of their families. So the news continues to flow. Bloomberg's Nick Wadham writing about how the crackdown on Russia's economy, though, could have consequences that last decades. Nick Wadham is Bloomberg News foreign policy reporter. He joins us on the phone from Washington, D.C. Nick, you know, the headlines continue to come in terms of moves by the U.S. And other nations around the world going against Russia at this point. Tell us about your reporting and why this may stay with us much longer than we all anticipate.
Well, I think the concern I heard from folks on the outside and also a couple of people on the inside of the administration is essentially that the U.S. is ramping up so hard and fast on Russia right now in response to the invasion that they fear there's not really like a longer term plan for, okay, then what? Like if you sanction all the folks around Putin and all these companies, what are the conditions under which you actually unwind these sanctions, and what are they actually trying to achieve? Is it just purely about punishment, or is it trying to induce some sort of behavior? And the problem sanctions theorists will tell you is that if you're trying to induce behavior with crushing sanctions like this, it often only just has the opposite effect. So it's a concern about not really understanding or thinking through what the consequences of all these sanctions might end up being.
Right. We understand the means in terms of going after Vladimir Putin and Russia, right? We see that with the sanctions. We don't necessarily know what the end game is here, certainly when it comes to the U.S. And NATO allies. What are some of the things that are being talked about that maybe need to be put before President Putin is saying, here's what we need you to do?
Well, I mean, this is a great challenge because, of course, obviously the first thing they would say is, okay, what we need you to do is reverse the invasion, which he's obviously showing no signs that he's going to do. So at that level, you know, it does feel like we're caught in this bind of wanting to do something, wanting to respond in some way, but then, you know, there's this concern that actually the response doesn't achieve the desired end. But the question that I'm really trying to dive into now is, you know, these lower level folks, so the oligarchs around Putin, you know, what needs to happen with them? What do they need to do? Do they need to publicly disavow Putin? What are the things that they can do that are actually in their control to get these sanctions lifted? And so far, I haven't seen a clear articulation of what the U.S. actually wants from them. And I think you're going to start to see that over the next little while, a better articulation of what they're actually going to need to do. But at the moment, the administration is not saying what it's asking them to do, if anything.
Nick, one of the things that jumped out for me in your latest reporting, and I think about this when we're dealing with leaders of countries that, especially in more troubled areas of the world, that we need to think about face-saving measures, that is important to them in terms of their position. How do we need to think about that when it comes to President Putin specifically?
Well, it was interesting because Jen Psaki was actually asked about that very issue today at the briefing. You know, is there some sort of face-saving measure that Russia could do? And her suggestion was, you know, it's way too early to talk about face-saving measures because this military campaign is so intense. But the impression I get from speaking to folks on the inside of the administration is that yes, they are going to, or they say they are going to start doing that at some point. The question is whether Vladimir Putin will see these U.S. actions as something that gives him the opportunity to do that. I mean, the U.S. is saying, listen, we're not going to commit troops on the ground, but Vladimir Putin doesn't see this as a substitute for war. He sees it as an element for war. So then that provokes the bigger question. Okay, he may respond not necessarily with financial retaliation or whatever it might be, but something more kinetic. And I think you're starting to see a sense that the U.S. is going to need to prepare for that.
Well, that's what I was curious too. And I'm thinking about sanctions in general. I mean, the world has ramped up, especially I feel like this week in terms of financial sanctioning, and whether it's stocks, the Russian market, the ruble, the oligarchs. Are we getting to the end of that in terms of financial sanctioning?
Well, I think there is more they can do. I mean, the question of whether it works or not, that's one thing. I mean, a lot of the oligarchs or the folks who were named today had previously been sanctioned, so it's not like it's going to have any real new impact on them unless the U.S., as it's promised, really goes after their assets in a way that it hasn't done before. But there is obviously the energy sector, and that is the big sort of untouched area where the U.S. has so far decided it is not going to sanction Russia because of the fear about the blowback on the U.S. market. But based on conversation I and some of my colleagues are having with officials and folks on the outside, it does appear that there's a growing movement toward figuring out some way to squeeze the Russian energy sector to really try to break the back of Vladimir Putin's calculus. Again, will it work? There's not a lot of evidence. I mean, you look at Iran, Syria, Cuba, there's no real evidence that their behavior has changed, but this is what the administration is looking at.
Hey, just got, Nick, about 30 seconds left here. So as you lay out, we've got to be, tell President Putin kind of what we need him to do. Are those conversations, though, going on inside the White House or among the president's cabinet? I mean, we just, played back some sound. He's meeting with them right now.
My
was
sense,
earlier.
From conversations is no, they are not at that point yet of telling Putin what he needs to do beyond halting the invasion. Hopefully we'll get a better sense of that in the next few days, though.
All right. Well, really appreciate the update. Nick Wadhams, he is our foreign policy reporter at Bloomberg News. Joining him on the phone from Washington, D.C. Check him out at nwadhams. You can find him on Twitter and other social media. All right. We are watching the markets bounce it around. The VIX is down despite the continued volatility that we are seeing. The S&P, though, call it flat, just up about 1 point after being higher and lower on the day. The Dow Jones Industrial Average right now up 0.3%, up 95 points. And we're looking at a NASDAQ that is still seeing some selling pressure, down about 1% or a decline of 127 points. All right, back to World and National News. Back to Nancy Lyons. She's in D.C. Hey, Nance.
Thanks, Carol. President Biden is imposing more sanctions on a number of Russian oligarchs and their families today. The U.S. and its allies are trying to exert more pressure on the wealthy businessmen around President Vladimir Putin in response to the invasion of Ukraine. Putin's press secretary is among them. One sanction, though, the White House is resisting is a ban on Russian oil imports.
That would raise prices at the gas pump for the American people around the world because it would reduce the supply available.
White House Press Secretary Jen Psaki says the U.S. is continuing to help Ukraine with intelligence. The war in Ukraine and the battle against the coronavirus have President Biden asking for more money from Congress.
The White House is asking for $32.5 billion in emergency funding. $10 billion of that would go toward Ukraine, mostly split between the Pentagon for military aid and the State Department for humanitarian efforts. The remaining $22.5 billion would go for COVID testing, antiviral treatments, and better vaccines for possible new variants. Congress has until March 11th to pass appropriations bills or another stopgap, or else it could face a government shutdown. The White House wants the emergency funds to be included in those negotiations. In Washington, I'm Nathan Hager, Bloomberg Radio.
The Supreme Court has ruled that Kentucky's Republican Attorney General may continue defending a restriction on abortion rights that had been struck down by lower courts. The justices rejected a federal appeals court's conclusion that the Attorney General waited too long to get involved. The case centers on procedural issues, not substantive questions about abortion rights. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Master and Tim Stanovic here in our Interactive Broker studio. Well, Carlos Ghosn, the former Renault-Nissan CEO who fled to Lebanon in 2019 after being arrested in Japan, says he has no regrets of creating the Renault venture with Russia's Avtovaz. Now, today, the French car maker, is being hammered by investors because Russia is Renault's second biggest market. Well, Ghosn spoke exclusively to Bloomberg's Anna Edwards, Matt Miller, and Kayleigh Lyons about the company's ties to Russia and the impact of the Russian invasion of Ukraine on the auto supply chain.
We were here on a mission to modernize the car industry in Russia for the benefit of the Russian users, but also for the benefit of AvtoVAZ itself and Renault itself. It made a lot of sense. We worked hard, we modernized the company, and everything was going well. This present situation has nothing to do with an industrial strategy. This is more a political situation on which the present leaders of the company should make statements. And I'm very surprised they're just not saying anything. Frankly, I think they are important, but they are not so important. I don't think that you're going to cripple the supply chain of the car industry because of what's going on between Russia and Ukraine. There are going to be hurdles, there are going to be challenges, but I don't think any car manufacturer has massive supply coming out of these two countries. This doesn't mean that there will be no problem, but management is here to solve them.
And that was former Renault Nissan CEO Carlos Ghosn. You can see more of that interview. Listen to it. Just head to Bloomberg.com. By the way, shares of the ADRs that trade here in the United States, they're down about 23% so far here in 2022, hitting a 52-week low today. They're under pressure over in Europe as well. 6.7% lower, though, in the trade alone today. All right, coming up, we're going to get to one of the most read stories on the Bloomberg. It is, in fact, a Bloomberg exclusive, and it all ties into the Bloomberg Business Week cover story. It has a deep look into using finances as a weapon in coming to a response against the Russian invasion of Ukraine. That's coming up next. This is Bloomberg.
events, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. The Dow just turning lower now, down 3 points. Little change, down less than 1/10%. Have been higher for much of the session. The S&P on the minus side now. It too have been fluctuating, down 12. A drop right now of 0.3%. NASDAQ lower by 179 points, down 1.3%. 10 years up 8/30 seconds. 10-year yield 1.84%. Spot gold up 0.3%, $19.34 the ounce. Bitcoin down 4.3%, 42,172 on Bitcoin. And West Texas Intermediate crude is slumping 2.5%, 107.79 a barrel. Brent down 2.2%, 110.41. Stocks fluctuating as the rally in oil eases. Crude experiencing an extraordinary run of volatility since Russia's invasion of Ukraine unleashed a new wave of uncertainty into global financial markets. Briefly, Sabre Corp and Amadeus Group, two of the world's biggest airline ticket booking agencies, have dropped Russian flag carrier Aeroflot from their distribution systems. And we've heard from oil companies, tech companies, and financial giants in halting their business in Russia. Today, World Wrestling Entertainment, WWE, announced it is shutting down its WWE network in Russia, effective immediately. Shares down 1.3%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
All right, Charlie, thank you so much. So this is one of our most read stories on the Bloomberg. It's also a Bloomberg exclusive, and it's in this week's new issue of Bloomberg Business Week magazine. It's a special report, by the way, the magazine. It's all about the war in Ukraine, and the magazine specifically taking a deep dive into the tactic of using finance as a weapon. So let's get to it. Bloomberg News financial investigations senior writer Stephanie Baker on the phone from London, along with Business Week editor Joel Weber here in our Bloomberg Interactive Brokers studio in New York. I talked with Stephanie earlier. I've already said this is, Tim and I were saying, favorite story of the week.
It is a really good one, and one of those ones where, you just are thankful for having colleagues who have been around and covering things for a bit, because as she writes in the story, Stephanie's been a close watcher of Russia for decades now. And to rewind the clock here, coming out of the wall coming down, oligarchs amassed a whole bunch of assets, basically, and were able to basically become billionaires in the process. And we've long seen the repercussions of that.
Right.
And a key way that sort of the U.S. and the U.K. and the EU are attempting to sort of fight back to Putin's aggression is by targeting some of those oligarchs. So Stephanie, walk us through how that's played out so far and how it could play out yet.
Well, the sanctions keep coming fast and furious. The UK and the US just announced additional oligarchs that have been sanctioned. The UK targeting two prominent Russians, billionaire Alisher Usmanov and Igor Shuvalov, who's a former government official, but he's the chairman of the state bank VB. And then the U.S. did the same, sanctioning Usmanov and a string of others, including their family members in many cases. So the U.S. going further, trying to put pressure on them. And, I think we're going to just see more coming as they work their way through the list and try to figure out, what's the best way to continue to put pressure on Putin. There are many more on the list, people, billionaires who, for instance, met with Vladimir Putin when he called them in last week. So I would expect further steps from both the UK, from both London and Washington.
So London's an interesting one here because Londongrad, long been a nickname, and UK's been a little slower on targeting and sanctioning them than the EU and US. And what do you make of that coming from London?
Yeah, it's been a real, they talk a tough game, the UK, but they've just failed to follow through. And I think, as you said, it's been nicknamed Londongrad because so many Russians love to come here and buy mansions and send their kids to schools here. But the legal climate is making it, I think, a little bit more complicated and difficult, particularly post-Brexit, for the UK government to move. And it's surprising that they didn't have a lot of this prepared, because they had been warning for so long about this invasion that they hadn't done the groundwork beforehand to try to target some of these oligarchs. The moves that they announced just tonight, there are 2 additional oligarchs that everyone has been saying, why aren't these guys sanctioned? But that's still a small step compared to what the European Union has done, which has been much more aggressive, sanctioning, triple the number that the UK has, and seizing yachts. French seized the yacht of the CEO of Rosneft, the state-backed oil company, today, and Usmanov, the billionaire who was sanctioned by both the UK and the US today, his yacht was sanctioned by the Germans in Hamburg. So, Europe has been the surprise player here in terms of its aggressive moves.
Stephanie, what's great about talking to you is that, and you write this in your story, that you witnessed the collapse of the Soviet Union back in 1991. You were in Prague. You were a recent college graduate. What is it that maybe we've misread as a world? Because there was so much hope there, hope at that time, but here we are today.
Yeah, 30 years, as a business journalist, I reported on it, Western companies trying to get into Russia. Obviously there's a whole sordid story of, how the Russian state went about privatization and created all of these oligarchs to begin with, and, huge problems in the way that was done. But now what you have is, and I think it's really sad, that there are a lot of, all this effort to try to integrate Russia into the global economy and create a sort of functioning business sector has been completely destroyed, in a week, because of the actions of Putin. And, it'll be very hard to recover that. But it's the only way, because the NATO does not want to be engaging in a direct war with another nuclear power. They have to use these sanctions as their only tool, really, to try to force Putin to stand down, to try to isolate him, starve him of the funds he needs to wage this war.
All right, we're going to leave it on that note. There's so much in this story, and there's so much in the coverage in the magazine this week. And Stephanie, we know you've been really busy, so thank you for finding time for us once again. Stephanie Baker, she's Financial Investigations Senior Writer at Bloomberg News, on the phone from London. Check out her story and the other stories that are in the magazine this week. You can find it on the Bloomberg at Bloomberg.com and on newsstands. And our thanks to Jill Weber, editor of Business Week. All right, March is Women's History Month, and every day this month we are celebrating significant moments in women's history. Now with your installment for this Thursday, March 3rd, here is Bloomberg's Renita Young.
On this day in women's history in 1913, the first major parade for women's suffrage took over Washington, D.C. Thousands of women gathered to call for a constitutional amendment guaranteeing women the right to vote. Women had been fighting hard for suffrage for more than 60 years by that time, but this marked the first major national event for the movement. The huge parade was spearheaded by Alice Paul and the National American Women's Suffrage Association. Parade organizers maximized attention on the event by strategically hosting it just one day before the inauguration of President-elect Woodrow Wilson. This tactic worked. That's today in women's history. I'm Renita Young, Bloomberg Radio.
All right, that, of course, was Bloomberg's Renita Young with the latest installment of Women's History Month. You are listening to Bloomberg Business Week. Coming up, we're going to check in with our TV colleagues. We've got to talk about the markets bouncing around once again. We are off our highs and lows on the equity segment, but we're going to pull out some of the highlights and the lowlights on this Thursday session. I'm Carol Masser. My co-host is Tim Stanovic, and you are listening to Bloomberg Business Week.
to the close. Bloomberg's comprehensive cross-platform coverage ahead of the U.S. market close starts right now.
This is Countdown to the Close. 60 minutes left in the trading session. Caroline Hyde, Romain Bostic, Taylor Riggs, and we are joined now by our colleague Carol Massa as Tim Stenovic steps out for a moment, and we welcome our full Bloomberg audiences, TV, radio, YouTube. And once again, some almost calm, dare we say it, Carol, in terms of stocks, bonds, but not still in commodities. We still power higher.
Yeah, I think that's a really important point. It does feel calmer, but you point out commodities. I was just looking at the swing in oil prices specifically. What is it, about 9% from peak to trough? I mean, we understand the fundamental reason why, Caroline, but nonetheless, it's pretty impressive.
And you know we're on pace now for what's going to be the biggest up week since 1960, Carol.
For oil?
For raw spot commodities overall.
For raw.
Do you know what's the best performing commodity on the week?
Is it wheat?
Oh, look at you.
Yeah, she's on it. She read up. 10 out of 10 to Carol thus far on the spot quizzes. Meanwhile, Romain's going to repeat that 1960 stat for a little while. And we're looking, though, at benchmarks that are just losing some ground, actually. The S&P 500 had been trying to get into the green. We're now down by 0.5%. Now we're seeing volumes actually pretty much flat on the day. We're down by 21 points. You're seeing a 76-point loss on the Dow, off by 0.2%. But your big tech and small cap is where the pain is really felt. 1.5 percentage points lower on the NASDAQ, 1.7 percentage points. That's 34 points lower on the Russell 2000.
And I finally have something new to say today, right? How often have we come on this program and said energy is the best performer for the year, the best performer for the day? There's actually a little bit of a shakeup. I think what's interesting, utilities and real estate are leading today, Romain. Those, of course, as we know, sort of the classic bond proxies. When bond yields fall, those sectors typically do a little bit well. But you also have staples up there as well, and industrials. And I do wonder if some of those staples are those companies, and I know that we'll have a great conversation with Gina Martin Adams, as we always do, about those companies being able to pass on rising costs to the consumer. Technology, though, at the bottom of the screen.
All right, well, you talk about some of the big movers here. Kroger, one of the biggest gainers here on the day, up 10% here, and this is primarily because of some strategic moves that the company's been making that finally seem to be paying off. But I think it's interesting here. Take a look at the next two lines here. Union Pacific shares are higher by about 1%. In fact, all the railroads rallying hard today. They rallied yesterday as well. When we talk about all the supply chain bottlenecks, particularly when it comes to shipping commodities, and the disruptions there, a lot of people now thinking, well, you're going to have to turn back to the railroads, at least for any type of inland transportation here. And so the speculation right now by traders is that we could see some benefits here for Union Pacific, Kansas City Southern, CSX, and the like. American Airlines and the rest of the travel stocks lower here on the day. They tried to rebound yesterday here on the idea here that maybe we were out of the woods, but now a reassessment of that. And keep an eye on IPG Photonics. We don't talk about this company much. I didn't realize it, but it actually has a lot of exposure to Russia. That's why you're seeing the shares down right now, down 10%.
Always managing to shine a light on those companies most exposed, Romain. Meanwhile, we're actually getting a little bit more movement in the Treasury market than we had earlier. We're now off by 3.5 basis points on that 10-year, so lower, so bond prices rising. And I, though, wanted to show that as we tamp down in some sort of volatility, Taylor, we are going to show this chart again and again and again, because now we should perhaps say that it's not September 1974, it is 1960, as Romain says, the biggest commodity shock in significant numbers of years, 50 years thereabouts, as we continue to see the ripple effects of Russia, Ukraine, and that ever march higher on the Bloomberg Commodity Spot Index, which is now at a 2014 high.
You know, Caroline, I'm so glad you brought up that chart. I'm so glad you talked about shocks, because speaking of shocks, we did hear from Jay Powell's second consecutive day of testimony, talking about a lot of different things. But he, you know, we were just talking with Mike McKee, one of the surprises that once again the Fed coming out and saying how surprised they were by the supply chain problems. Let's listen up.
It's just taking so much longer for the supply side to heal than we thought. There really is no precedent for this. We looked at it the way it was. There were certainly some voices, and they've turned out to be right so far. Ultimately, we think the supply side will improve, and that'll help with inflation. In the meantime, we're going to use our tools, and we're going to get this done.
So again, Fed Chief Jay Powell up there on Capitol Hill, day 2 of testimony. Again, not surprised maybe by the supply chain problems remain in itself, but just how long they have endured. Yeah. That is something that is surprised. To be fair, the Fed officials, and so many others.
But what are the tools here that's actually going to rein that in? I mean, barring some sort of demand shock that is sort of induced by the Fed or by fiscal policymakers in some way, I'm just a little confused as to what he thinks is going to be the solution, at least from as far as the monetary policy levers go.
Should we do it? The daily reminder.
And I didn't watch this today because it was on the Hill yesterday, right, on the House. And it was Senate, and I was distracted. I was out running around. I went downtown to get a burrito and got kind of lost. But when we talk about sort of what happened, I mean, it's a long way. And when we talk about sort of what he can do, or what the Fed should do, I shouldn't say he, you know, I think a lot of people kind of feel like, barring some shock and awe by the Fed, a 25 basis point cut isn't going hike, isn't going to do it.
Well, it certainly brings up a lot of the issues about at least trying to hamp down inflation without punishing growth too much, Caroline. And I think what's so interesting, we've talked about pushing forward to Jobs Day tomorrow, the tools that the Federal Reserve has, getting a decent jobs number tomorrow as we wait a CPI print, which in many cases people have said might actually be more important in many respects than Jobs Day as we push forward and think about the Federal Reserve's goals. I'm just taking a look at the range. Morgan Stanley, Ellen Zentner's increased her forecast for 730,000 jobs in February. Wells Fargo, though, today cutting theirs down to just 375. So you're really getting a big range.
Is this going to be one of those jobs reports where everybody gets it wrong once again? That's happened twice.
I mean, let's face it, it probably will be because, well, when you're trying to get a mean or a median read from when the overall breadth of views is somewhere in the lowest is 80. And the highest is in excess of 700.
Yeah.
I mean, where are you going to find any sort of consensus number within that?
You know, it's backward looking, we know that, but it's still important. But I do wonder when companies, they're paying higher wages, and if they're, you know, their producer costs continue to be expensive, like at some point, do they have to stop hiring, cut costs somewhere? Yeah. And so I feel like, I don't know whether it's future jobs reports is going to be important.
Range?
What?
Did you say the range?
Caroline did. 80 to north of 7, right? Okay. Ellen Zentner coming in at 730.
I mean, but this, to your point, Carol, exactly right. The fact that we're at full employment, maximum employment, that is what the Federal Reserve thinks. But what therefore of wage inflation within that? Is any number going to shake them really? Look at the ISM data today. It actually didn't look too pretty on a jobs front.
I'm glad you brought that up. That services data, I mean, that was kind of alarming. And I think a lot of people aren't really taking into account why the market sort of started to shift downwards a little bit earlier in the day. A lot of it was tied to that, Carol.
Well, and it's interesting. You talk about full employment, was doing a shoot and, you know, at a company where they have hiring signs all over the place, and there still is. So you do wonder about how many more can still come back into this labor market.
Are we?
Well, I mean, this is that debate that goes on and on and on.
Do you know how much I paid for that burrito today?
How much?
$9.
Oh. How much more would you pay for that burrito going forward?
$9.
How much avocado did you have in there?
It was pretty good.
Okay. Would you pay $10? Would you pay $12? All right, we're going to have to continue this later because we've got other stuff to do. All right, we're going to be back in less than an hour's time for Beyond the Bell, our cross-platform coverage on radio, TV, and YouTube. It will continue. We're going to count you down to the close a little bit later on.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, lots of questions out there. It was really interesting. I was thinking about what Mike said to us earlier about NFP, that not focused on payrolls, and yet we got there because it is something we will be focused on at 8:30 a.m. Wall Street time. Carol Masser, Tim Stenovic here in our Interactive Brokers studio. Still a lot of questions, though, about price increases. Jay Powell, talking about kind of surprised by how long, these supply chain problems have persisted. So I don't know. I don't know what the answer is.
Look, now it's not just supply chain, but it's energy too. And you throw in the crisis in Ukraine, which the Russia invasion of Ukraine and potentially cutting off Russian oil supplies. And what does that do for the global market and global prices there? And that hits American consumers.
And there'll be an adjustment perhaps. Do we see Europeans, look permanently elsewhere for their energy supplies? Do they increasingly ramp up when it comes to alt energy? But we know that's going to take some time. Yeah. So again, what this all means longer term, I guess, is still obviously very up in air, as much as we'd all like to see an end to the war in Ukraine, because there are people being impacted.
Yeah, and look, the humanitarian cost of this is great, and it's something that we talk about a lot, Carol. But this is also a program that focuses on the markets and investors, and we're seeing global implications of the war as it does enter its second week on markets, on oil, on commodities, and we bring you all that coverage too.
All right, we're going to continue tracking it as we see the markets bouncing around, big swings, certainly when it comes to the energy markets and crude oil specifically, but we're getting back near our lows when it comes to equity.
And today, hoping to reach some common ground. They did agree to create safe corridors in order for Ukrainians to leave the country. More than 1 million people have already fled. But the UN's High Commissioner for Human Rights, Michelle Bachelet, is more worried about those still in Ukraine.
Tens of millions of people remain in the country in potentially mortal danger. I'm deeply concerned that the current escalation of military operations will further heighten the harm they face.
Bachelet says hundreds of women are giving birth in bomb shelters as the attacks continue. The chairman of the Federal Reserve Board, Jerome Powell, shifted his focus to the Senate Banking Committee today and provided an update on the state of the economy and measures to limit inflation. Yesterday, he spoke with the House.
Powell spoke of the uncertainties created by the Ukraine war. He was asked to elaborate.
Commodity prices have moved up significantly, energy prices in particular. That's going to work its way through our U.S. economy. We're going to see upward pressure on inflation, at least for a while. In addition, you could see lower investment. You could see people holding back on spending.
Powell said the best way to keep the strong labor market going is to address price stability. In Washington, Irv Chapman, Bloomberg Radio.
The United Nations is moving forward on the first global plastic pollution treaty. The resolution, which addresses the full life cycle of plastic, will be developed over the next 2 years. A top UN official says it's the most significant environmental multilateral deal since the Paris Accord. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Carol Massar, Tim Stenovic in our Interactive Brokers studio. Let's talk about Rivian.
Yeah, so this was one of my decliners yesterday, Carol, because the company came out yesterday, or the day before yesterday, but the stock got hit yesterday and said that it was raising its prices for people who had put in pre-orders on some of its vehicles. This was wild. This was one of the worst performers yesterday in the S&P 500. I go home. Okay, I'm scrolling through Instagram last night, and I go to Instagram stories, and I see a story from a guy I know from years ago.
Yeah.
It's a story about him canceling his order, an email from Rivian that's saying, confirmation confirmed that you've canceled your order. He tagged a Rivian fan site in it. I went to the Rivian fan site, and it's just a collection of people who had already made orders for Rivian vehicles, canceling those vehicles because of the price increase. Now Rivian coming out today, canceling that price increase for pre-orders. So what they had done was they had said, okay, well, you put that pre-order in, we agreed upon a price, it's going to actually cost more because of supply chain issues, and people were really upset about it.
Well, all right. I mean, it was what? 17% on the pickup higher and 20% on the SUV, and they did talk about higher input costs and a shortage of semiconductors. So is that just the cost of doing business and trying to complete those orders? And so is this just a reminder that it depends on the product? Because we've talked about a lot of companies, different, not apples to apples, but other companies that have passed through price increases and customers are like, okay, I'll pay for it.
It is, but there's a question of like, you know, you put a pre-order in for something and you agree upon a price, and then they come back later and say that that price has shifted, and that's what the outcry was about. So what Rivian has said now... So in other words,
there was a contract.
I don't want to use the word contract because I don't know those details, but yes, an agreement, I would say, is a fair term to use. But for those customers, Carol, as Ed Ludlow points out, it's going to honor the original price for customers who placed pre-orders prior to March 1st when the increase was announced. So buyers who then canceled, like the guy I follow on Instagram, they're going to be allowed to reinstate orders at the original price, timing, and configuration, so he can go back and make that order.
Shares of Rivian are down 51% so far this year. I mean, it's a $50 stock, so it is way down from, I'm looking at its 52-week high of 179 and change. What's interesting, we'll see how many of those who canceled come back.
Yeah, I think that's going to be a question that analysts certainly have at the company's next earnings call.
All right, we'll be keeping a watch. Shares are under pressure, though, today. This is...
headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. 43 minutes to go ahead of the closing bell with the Dow, the S&P, NASDAQ very much in the red. Let's head right over to the first word, breaking news. It's been a choppy day. Here he is with today's afternoon call, Bill Maloney.
And good afternoon, Charlie. That's right. U.S. stocks down in a choppy session. The Dow is currently down 61 points. S&P's dropped 23, while the NASDAQ is off by 232 points. The U.S. 10-year yield at 1.84%. Gold is up 8. Oil is down. And Bitcoin is dropping by 4.6%. Among the main 11 S&P sectors, utilities, real estate, and consumer staples were in the green. And leaders to the upside in the Dow, Walmart, IBM, and Amgen, while Boeing fell 4.5% and led to the downside. After earnings, Snowflake plunged as much as 19%. Kroger jumped 10% to an all-time high, and Best Buy rose 9%. In deal news, Pentair to buy Manitowoc Ice for $1.6 billion. And wrapping things up, Broadcom and Costco report after the bell. Live from the First Breaking News Desk, I'm Bill Maloney. Charlie.
Okay, we thank you very much, Bill. And to hear live breaking news over your Bloomberg, type Squawk SQUAWK on your terminal. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. Bloomberg Business Week is brought to you by SEI. Crises and challenges highlight the power of partnership and character. Work for the common good, one community. SEI. Go to SEIC.com/banks.
All right, you're listening to Bloomberg Business Week. Now, Snowflake, that's a software company. You've heard of them, of course. We've talked about them. It helps businesses organize data in the cloud. They did post their biggest drop ever today after projecting that annual product sales growth would slow from its previous triple-digit percentage pace. Berkshire Hathaway, by the way, owns about 2% of outstanding shares, or at least owned them as of the end of last year.
Let's get into it with Joe Williams, technology reporter at Bloomberg News. Joe joins us on the phone from San Francisco. Joe, I want to steal a question from Tom Keene, who I heard talking about Snowflake this morning. He said even though we've basically, people have heard of it, but they don't necessarily know what it does. So explain to people who don't know exactly what Snowflake does. What does it do?
Yeah, absolutely. So Snowflake serves as a basically repository for corporate information, and it's used by folks like business analysts to be able to pull, say, sales figures, things that power the corporate dashboards that CEOs look at routinely, as well as other data visualization from all areas of the business. It's mainly used, again, in a way to look at historical, or traditionally it's been used to look at historical information, things that have already happened, and give that insight into the business.
All right, so investors really not happy. We see the stock under incredible pressure today. It's still down about 17%, so it's been hovering near its lows. What is it that has got investors so freaked out here?
Snowflake is trading at about the highest multiples within the software category. So essentially it was priced to perfection. And for the last several quarters, that's been great because the company has delivered. You've seen over 100% growth. And the CEO has been out there kind of touting how big of opportunity they have with all the immense amount of corporate data that's being created now. This is, I think, a reflection of the fact that they had a stumble and that it, no longer should be or can be priced at that kind of perfect level that it has been, which I think is why you're seeing the sell-off and maybe just, a bit of reality check again on the future of the company. Still very solid, I think, in a lot of its financials, but just, a bit of just a come to earth moment for a stock that has been performing extremely well for the past couple of years.
Joe, what about the part of the story that has to do with the price cut? The idea, and you write this in your piece today, that products will let customers get the same results by spending less, which is going to hurt revenue in the short term, but it should grow the business in the future.
That's the rationale that the executives on the call used. This is not the first time that Snowflake has done this. They've talked in the past about the ability, the way that they have structured and built their system to be able to push through these updates that effectively lower costs for customers while letting them do the same thing. It sounded like this one came as a bit of a surprise of just how significant it was. But again, the long-term philosophy here is that if we make costs cheaper for our customers, that they'll continue to move more data and do more things within Snowflake that'll eventually recoup those losses through the remainder of this year and then into the next.
Are they right? What does the investment community say about that in terms of that premise? Because right now, they're telling us they don't buy it.
I think it definitely took some by surprise. I think, there were questions in the call around, they've never heard of a company that has used this model before. But I think, when you look at a lot of the analyst reaction, they tend to trust Frank Slootman, who is the CEO and has a reputation, of being able to effectively lead organizations. And I think it's confidence in him and confidence in the leadership team that is, at least I think, giving the analysts the benefit of, them giving the benefit of the doubt to the company. And again, this is something that they've done in the past. I think, again, this was just an outside hit that they weren't maybe expecting as much. But it's something that is, not new to the business. And I think as they continue to evolve and grow as a company, I think you'll see them perfect this a little bit better so that there is not as much of a, again, outside hit that will lead to such a harsh reaction from the markets.
Joe, talk to us about the space that Snowflake exists in right now and who competitors are, and if a customer of Snowflake can easily jump from Snowflake to someone else.
Yeah, so Snowflake it serves as a cloud-based replacement for a lot of the kind of legacy systems, Teradata, Oracle. Executives talk a lot about when they go into companies and when they get their wins, it's mostly replacing those historic systems, again, the Teradatas and the Oracles. You're seeing a lot of competition, though, from upstarts like Databricks, as well as other companies that really seek to undermine Snowflake's core offering. And you've seen Snowflake make a lot of investments to help push back against that and help maybe shield customers from wanting to leave. It's also extremely costly and quite difficult to move data from Snowflake once it's already in Snowflake. So there's a stickiness factor to it where as customers use it more, it becomes more difficult for them to back away from the product. And the company has an outstanding net retention level, which means customers, their biggest customers, are spending more and more with them every year. So you can definitely see a trajectory where, they become very ingrained within the business, but at the same time, there's tons of investment and tons of competition.
Joe, it sounds like nobody doubts that the data storage and analytics sector, that it's a business that's going to be around for long. The problem is there are more and more companies getting into the space, so it gets more competitive for Snowflake. Just got about 20 seconds. Is that kind of bottom line on it?
Absolutely. And a lot of, the attention now is looking to saying forward-looking analysis. What is the sales forecast going to look like? What will customer churn look like? And those are the investments that Snowflake is making to make sure that their platform can do that and withstand some of the competition from vendors who already offer that to their own users.
All right, copy. Thank you so much. Snowflake shares down 17% as we speak. And that was Joe Williams, technology reporter at Bloomberg News, on the phone from San Francisco. Right? Good business, but when it gets a little crowded, it could be tough for companies.
Yeah, Warren Buffett backed this company too.
Right, which is interesting, right? We always like to look at who owns it. All right, folks, this is Bloomberg Radio.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130 to Washington, D.C. Bloomberg 99.1 to Boston. Bloomberg 106.1 to San Francisco. Bloomberg 960 to the country. Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
All right, you are listening to Bloomberg Business Week on this Thursday. Carol Master along with Tim Stanovic. We've got another story. It is among our most read on the Bloomberg that we want to bring to you, and it has to do with Russian assets and those index funds.
Yeah, MSCI joining index providers, making changes amid the turmoil in Ukraine. We're talking Russia's invasion of Ukraine, of course. We're going to have that story right after this. That's, of course, Charlie Pellet with an update on what's happening in the markets. Hey, Charlie.
Thank you very much. And certainly the war in Ukraine, major theme for investments. So many moving parts to all of this. Right to the numbers. We'll give you some color on what's going on in a moment now. 28 minutes to go ahead of the closing bell with the S&P down 22, a drop right now of 0.5%. We've got the Dow down 72, lower by 0.2%, while NASDAQ is slumping 229, a drop right now of 1.6%. Tech stocks are dragging down the equity market ahead of tomorrow morning's jobs report as traders weigh the impacts of the war in Ukraine. The rally in oil has eased. Crude is experiencing an extraordinary run of volatility. Several big up days in a row. Today we're seeing a retreat. West Texas Intermediate down 1.7%, 108.71 on WTI. Brent, the global benchmark, 111.12. Barrel of Brent down now by 1.6%. Spot gold is up 0.6%, 19.39 the ounce. 10 years up 6.30 seconds. 10-year yield 1.85%. Equities lower across the board. S&P down 26, down 0.6%. The Dow down 91, drop now of 0.3%. Nasdaq is down 240, a decline of just about 1.8%. Well, as for the inflation outlook and where it leaves the Fed's rate hiking path, Nisha Patel is portfolio manager at Parametric Portfolio Associates.
If we see that 8 handle next week on the inflation number, this just puts on, I think, a lot more pressure on the Fed. And so, I think, again, at minimum, you're looking at 25 basis point hike for the rest of the year. That puts a total rate hike over the next, let's say, 8 to 12 month period on the lower end of what all previous tightening cycles have done.
After earnings, Best Buy shares, they're up by 9.5%. Lots of earnings coming up after the closing bell. Among those names, Broadcom, Costco, and Gap. I'm Charlie Pellet. That's a Bloomberg Business Flash.
All right, Charlie, thanks for the update. So another of our most read stories on the Bloomberg today has to do with indexing. Major index providers officially cutting Russian assets from their gauges, so really ratcheting up the pressure on exchange-traded fund industry, already facing an extraordinary stress test. We know what happens then.
Carolina Wilson is senior emerging markets reporter for Bloomberg News. She joins us on the phone from New York. Carolina, how does it work when you actually drop a company or a group of companies, in this case a region, from an index fund? How is that done?
Yeah, hi, and thanks for having me. It depends. It depends on the funds that we're talking about. These bigger indexes by MSCI and FTSE Russell, they're tracked by broader emerging market ETFs, those that cover the global complex a bit more generally. And those have a pretty small exposure to Russia, maybe 3 to 4% of the fund holding. So the bigger stress question here is, what does this mean for those single country ETFs holding Russian assets a bit more exclusively? And while some of it is a wait-and-see game, we know that many of these funds will have difficulty actually selling those underlying Russian assets to either comply with these index changes or in response to investors trying to enter their position.
Carolina, I remember a time when the fund industry was starting, right? And those big country, single country funds were massive, and that's how investors would often, look to get exposure, especially when it comes to an emerging market like Russia. But I'm curious, how much money are we talking? What kind of, fund flows have we been seeing in these specific type of funds?
Sure. So when we look at sort of the globally listed ETFs tracking Russian assets a bit more exclusively, as of close yesterday, that was about, I believe, $1.7 billion. And you're right, Carol. So, part of the beauty or attraction of ETFs is that they promise you this access to this otherwise kind of tough to invest in parts of the market. So even if the funds are having trouble washing their hands of these underlying Russian for now, a lot of these ETFs are trading in the secondary market.
Okay, so let's go from that index conversation to more the ETF conversation and speak a little bit about what's happening in these funds right now on the actual fund level. So because we've seen a lot of activity with RSX, for example, the VanEck one with the ETF with exposure to Russia. How does trading work there if the funds are being removed from the index and if they're not creating new shares or like taking in new money, but it's still being traded on the secondary market? Because this is something that people can still access using their trading, like retail investors can still access using their trading platforms.
That's right. It sort of looks like a mess, right? Like at the surface level. So
yeah.
If the underlying local Moscow exchange is shattered, there will be a massive price dislocation between the fund's trading price and its net asset value, or the value of those underlying securities. But it does allow the fund to act as a sort of price discovery vehicle. And that's what a lot of people in this market will say. For an otherwise untradeable market, here's kind of a look at what investors feel like it should be priced at. And it's something that we've seen in the past. The story talks about how the industry has been tested in this way before. Back in 2015, when the Greek stock exchange closed during the country's government debt crisis, the Greek-specific ETF was available to investors. During the Arab Spring, when the Egyptian stock market closed, that VanEck Egypt ETF continued to trade. And in both events, there was a big gap between the ETF price and its NAV. And in both situations, the fund acted as price discovery vehicles while those securities couldn't trade in the underlying markets.
Is part of what's tricky now is, could we potentially, if this war, let's be honest about what it is, this Russian war against Ukraine, fingers crossed, resolves itself sooner rather than later, could all of this just come undone very quickly? Or it doesn't necessarily, we shouldn't assume it's going to happen that way?
Right. It absolutely has to do with timing here, right? So depending on how long we see this war ongoing, depending on how long these sanctions remain sort of firm, if it's too long, I could foresee some of these funds having to close down. We've already seen one liquidate. We've seen several, as Tim mentioned, sort of halt their creation. So depending on timing here, these things could sort of pop back up and continue to trade, or we may see some more closures in the market.
This might not be something you can speak to, Carolina, but it's something that Carol and I have been talking about is depending on what happens, these sanctions might not be lifted for a really long time.
Right.
And even if they are, what is the appetite for actually doing business in this area of the world, given what's happening right now? Like, that might not continue.
It might not, and it's all about risk. It's risk appetite, right? And so also, if we see some of these investors who like these single country ETFs and have liked this Russia exposure for a certain aspect of their risk portfolio, the question is, where will they turn to for that risk appetite? Where will they turn to for that yield? And so that's sort of why we continue to monitor flows and see, follow where that money will go.
Right, because emerging markets, we know risky, and sometimes that's where bottom feeders come in, but nonetheless, we'll keep an eye on it. Carolina, thank you so much. Carolina Wilson, she's Senior Emerging Markets Reporter at Bloomberg News. Her story among the most read on the Bloomberg Terminal.
Well, let's head to Washington, D.C. for a check the latest world and national news with Nancy Lyons. Hey, Nance.
Thanks, Tim. President Biden says sweeping economic sanctions on Russia are having a profound effect, calling them unprecedented. Biden opened a cabinet meeting this afternoon by announcing another round of sanctions on Russian oligarchs.
Today, I'm announcing that we're adding dozens of names to the list, including one of Russia's wealthiest billionaires, and I'm banning travel to America by more than 50 Russian oligarchs, their families, and their close associates.
Biden says the U.S. is continuing to support Ukraine in its fight. President Biden is walking a fine line between pressing Vladimir Putin for his invasion and ensuring that the crisis does not spin out of control. Bloomberg's Amy Morris reports.
Even while pushing sanctions and boosting Ukraine's defenses, the Biden administration has held off responding to what it sees as overt provocations from Moscow. When Putin announced that Russia's nuclear arsenal was on high alert, Defense Secretary Lloyd Austin postponed a scheduled ballistic missile test just to avoid any misunderstanding. U.S. officials tell Bloomberg News the approach reflects the Biden administration's desire to inflict economic pain on Putin while avoiding unnecessary risks. In Washington, I'm Amy Morris, Bloomberg Radio.
A Kentucky jury has cleared a former police officer who fired shots during the 2020 drug raid that ended with Breonna Taylor's death. The jury today found Brett Hankinson was not guilty of endangering neighbors when he fired through sliding glass side doors and a window of Taylor's apartment. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries.
All right, Nance, thank you so much. Carol Massar, Tim Stenovic. We are live in our Bloomberg Interactive Brokers studio here on this Thursday. We mentioned earlier about upped and amped up sanctions against wealthy Russians. President Biden, talking about it. What I meant to say is that it also included Vladimir Putin's press secretary, also limiting the travel of 19 others. So we are increasingly seeing moves taken against the Russian oligarchs.
Yeah, among the stories on the most read on the Bloomberg terminal are a couple about what's happening to the status of assets belonging to oligarchs all around the world. I want to start with Alexei Mordashov, who spent years meticulously mapping the handover of his multi-billion-dollar empire to his children. In the span of a bloody week, though, those plans, Carol, have gone out the window.
Yeah, he's made a fortune in steel in the newly post-Soviet Russia. He was sanctioned Monday by the European Union in the wake of his country's invasion of Ukraine. Filings in the UK this week show that he had shifted control of a roughly $1.1 billion stake in mining company Nordgold to his wife. That wasn't all. He was also forced to step down as a company director. He resigned from the board of a travel giant that he rescued in 2020. But what's interesting is even with that shift doesn't necessarily mean that it's protected.
Yeah, that's right. So let's go over some of the sanctions that we've been talking about in recent days. Russia's richest people are scrambling to shelter or divest assets in the face of real or threatened sanctions as regulators around the world zero in on business people perceived as close to Putin. Roman Abramovich, we talked about this yesterday, announced that he's selling his Chelsea football club. Sanctioned oligarchs Peter Avin and Mikhail Friedman have resigned from the boards of their shared investment firm Letter One, and that owns billions of dollars in energy, telecom, and retail assets.
Bottom line, we're just seeing an increasingly ratcheting up of the pressure on the Russian oligarchs. In keeping with that, and I'm sure you've heard about this, we've certainly been covering it, Rosneft Chief Executive Officer Igor Sechin's super yacht was blocked by French customs officials on the Côte d'Azur, part of the European Union sanctions against wealthy Russians with close ties to President Putin. So you're seeing it just happening around the globe. This is Bloomberg.
headlines and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Stocks lower. We've got 13 minutes to go ahead of the closing bell. Very close to session lows. Right now, the S&P down 36, drop now of 0.8%. The Dow is down 165, lower by 0.5%. Tech stocks dragging down the equity market ahead of tomorrow morning's jobs report as traders weigh the impacts of the war in Ukraine. Nasdaq is down 271, drop there of 2%. The Nasdaq 100 index down 1.9%. 10-years up 7/32, 10-year yield 1.85%. Spot gold up 0.6%, $19.39 the ounce. Bitcoin is down 4.8%, 41,968 on Bitcoin. And West Texas Intermediate crude is slumping 1.9%, 108.52 a barrel. Among some of the companies reporting earnings after the close of trading, we'll hear from Broadcom. Its shares down now by 1.6%. Costco higher by about 0.8%. Another retailer reporting today, Gap out of San Francisco, Gap now by 2.6%. Recapping, S&P down 0.8%, 10-year yield 1.85%. I'm Charlie Pellet. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
This editorial was written by the Bloomberg Editorial Board. Some 8 million metric tons of plastic end up in the ocean each year, the equivalent of a garbage truck every minute. At this pace, the seas may have more plastic than fish by mid-century. The good news is that nearly 200 countries have just agreed to hammer out a treaty cleaning up the plastic mess, and businesses and policymakers don't need to wait to take action. Manufacturers can start by boosting the amount of recycled content they use and by producing simpler packaging that's easier to recycle. And governments can aim to make inventive replacements for plastic made from materials such as algae more cost competitive. The plastic emergency has been building for years. Unfortunately, the world doesn't have the luxury of time in solving it. The sooner these efforts start, the better. This editorial was written by the Bloomberg Editorial Board. For more Bloomberg opinion, please go to Bloomberg.com/opinion or OPIN Go on the Bloomberg terminal.
This has been Bloomberg Opinion.
I'm driving in my car.
How about you let me drive?
Oh, no. Who's gonna drive you home? Honey, please, I'll do the driving. Drive on. Excuse me, I want to drive. It's the question that drives us.
This is the Drive to the Close.
That funky music will drive us till the dawn.
On Bloomberg Radio.
And just about 10 minutes left in today's trading session. In a session where we've seen those major equity averages bouncing around, we're pretty much at our lows of the session, as we just heard from Charlie, on that NASDAQ, really taking, Tim, the biggest hit on a percentage basis. It's down 2%.
Yeah, really being dragged down by names like Amazon, Tesla, Microsoft, NVIDIA, Facebook, Apple, Google, AMD, and more. That list certainly goes on. One person who we love to have on talking about a lot of those names and more is Sylvia Jablonski, Chief Investment Officer at Defiance ETFs. Sylvia joins us on the phone from New York City. Sylvia, it's great to have you with us. I want to start with some of these tech names and the way that, that tech is really underperforming as a whole today. I know that, you and I spoke earlier this week on Quick Take Stock, and you told us that, tech was really an area of interest for you guys and where you saw opportunity for investors to go in and buy the dip.
Hi, yes, good afternoon, and great to be with you again today. You actually listed off a lot of my shopping list right now. So
interesting.
So definitely a great conversation to have. So, my sense of this is really that, although the geopolitical situation, Russia and Ukraine, is obviously dominating the news headlines everywhere right now and is a major, humanitarian issue, very obviously, and it is impacting markets. I think that even prior to that, sort of the Fed and the fear and volatility in the market had taken some of the froth off of what was thought to be overvalued mega cap tech names, some of the ones which you've listed. And, when I look at some of those names like Apple, Google, Amazon, Microsoft, to name a few. If you look at some of the earnings information and kind of look back to it, cloud, for example, cloud for a lot of those companies grew 36 to 40%. Google is going to have ad growth with the sort of reopened trade. On top of that, cloud growth there. Apple's involved in augmented reality, potentially the future of Web 3.0, the metaverse, plus subscribers, streaming products, and you name it. So I think these companies all have sort of diversified business lines. They have a lot of cash. CapEx is strong. Some of them, Microsoft in particular, giving back a lot of cash to investors. And I just think that they remain resilient. So when I look at them, a NASDAQ more than 15% off highs, given today's market activity anyway, and some of these names off of their all-time highs with multiples pulling back, I really like it here, and I think that this is going to be a FOMO trade.
What's interesting too, and talk to me a little bit about your investments that you got. You invest in hotel, airline, and cruise. It's traditional, and that your ETF is down about 2% this year, but you really do tap into the changing world, the innovative world, and your digital revolution equity ETF down 20% so far this year. Your Defiance Next Gen H2 down about 17%. That's energy, hydrogen, next gen fuel, which we are talking about so much in the context of the Russian invasion, Ukraine, and the world rethinking how it gets its energy. Your next gen SPAC, we know SPACs have been having a tough time, down 18%. How difficult, though, is this for you guys and for you specifically, this environment?
It's difficult, right? When you see those performance numbers and whatnot, and if you kind of look at what is in our ETFs, most of it is disruptive technology, and so that's what's being hit the hardest right now, and not far behind the NASDAQ. But with all of those trades, so the reopen trade prior to things sort of heating up and intensifying to the level that they're at, which is even just a week ago, Marriott, Hilton, Southwest Airlines, Delta, United, sort of pick the travel reopened name, Royal Caribbean, were well, more than outperforming S&P 500. You had an S&P 500 at that point down 8%, and these names were all up, 7, 8, 9, 10%. So, and really the tensions kind of threw that back, and now that's down 2%. But once we sort of get past this, I expect to see, part of the healthy economy and reopen trade, a lot of growth there. And in terms of the other names, hydrogen, I think, is part of the conversation. We're talking about climate change, and now here we are, and there's a big debate about whether, well, maybe we should be drilling for more oil because look at this sort of situation. But I don't think that we're going to go that direction. I think that, another way to look at it is maybe we should continue to invest in things like fuel cell technology and hydrogen, solar and green metals, so that we don't need to rely on, some of these environmental types of commodities that are, sort of keep holding us hostage a little bit right now. And
Sylvia, we spoke to the CEO of Plug Power yesterday. Is that a company that you guys include in any of your funds?
It is. It's one of the top holdings in the hydrogen ETF, and I think what they're doing is great. I mean, they're creating this sort of situation and are a huge asset for the future use of hydrogen and fuel cell technology to power everything from cranes, buses, bicycles, cars, and airlines. So it's a huge trend for the future. And same thing with the quantum and the 5G. I mean, there's just no doubt in my mind that the world is going to change, and if we're going to have electric vehicles, augmented reality, Web 3.0, these things don't happen without semiconductors, 5G, and some of those disruptive technologies that are just getting hammered right now.
So new money, somebody has to commit. I mean, how much new money is coming in right now for you, or is it is it not happening?
In all honesty, I think that we see a lot of investors sitting on the sidelines. So we're actually not really losing much, which is great. A lot of the depreciation is from pricing, right? Because the stocks are sort of down, markets down, so NAVs are down. So it's good to see that the shares outstanding remain strong. And we're seeing a lot of flow actually into hydrogen and into cruise, the travel-related ETF right now. And everything else, I mean, as you would suspect, I think that there's enough fear out there. But it's like 2020, March 2020. It's sort of another lost year, but for a different reason. And I think when we look back on this, we'll see, I can't call the bottom here, right? But I certainly think this is a good
dollar cost averaging type of, week and month.
Yeah, and I thought that's telling what you said. You can't see the bottom yet. It's very tricky, and we certainly hear that from lots of other folks who are watching this market environment. Hey, Sylvia, thank you so much. Sylvia Jablonski, she's Chief Investment Officer at Defiance ETFs, with us on the phone in New York City. This, as we see equity markets, certainly the NASDAQ bouncing off its lows, but still down about 1.6%. Dow, we're looking at a decline of about 0.4%, and the S&P 500, Tim, just down about 0.6%. So off our lows, but just barely. Now we're looking at a decline of about 0.4%, and the S&P 500, Tim, just down about 0.6%. So off our lows, but just barely. All right, coming up next, we're going to be joined by our Bloomberg TV team for Beyond the Bell, live on Bloomberg Radio, Bloomberg TV, and YouTube. We are counting you down to the close on this Thursday.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs counting you down to that closing bell, here to help take us beyond the bell. It's our global simulcast, joined right now by Carol Massar, Tim Stenovic, also blessing us with his presence, bringing together our Bloomberg television, radio, and YouTube audiences worldwide to parse the crucial moments of the day, crucial moments that Tim missed a little bit earlier. But Carol, you were actually here and keeping an eye here on the markets here. A lot of those tech and discretionary names really dragging the equity market lower.
Yeah, we're going to talk about that. We are definitely seeing it play out in the market environment here, bouncing around a lot. I was just looking, though, at the week overall. I mean, energy is your best performing play, and I was looking at Occidental. It's up about 23% so far this year. We understand why, but, it's just a reminder, again, of there are gains and losses, certainly, within the market environment.
Yeah, sorry to miss you guys earlier. I was out getting a burrito, but I'm back now, and I'm no longer hungry. The SOX is something that I'm keeping an eye on, Caroline. Down more than 2.2%, really underperforming the major indices. We're seeing 28 of the 30 companies in the SOX lower right now.
And it's notable the volumes are elevated. When you're looking at the NASDAQ, we're up about 13% in terms of your average daily volume versus the 20 days. Everywhere else pretty much flat to, if not slightly down. So the NASDAQ, big moves and big volumes.
Interesting, though, the sort of calmness, if we will, the stability within the bond markets. We're in day two, again, sort of wrapping up the comments that we had from Jay Powell. Big sort of movements yesterday, Romaine, as we had a big reflationary upward, but a two-year yield that is mostly steady at about a 153. So we're about 7 basis points from the highs of about 160 that we had last week.
Yeah, and of course, now we're entering into a very critical period, at least if you keep an eye on economics, data, as well as monetary policy. That jobs report tomorrow, a CPI report next week, and then, of course, that Fed meeting